We'll start with the first items here. And are we officially online now at this point?
Scott.
I'm sure.
Okay.
Personal.
This meeting is called to order. Members of the public are welcome to address the board on subjects both on and off the agenda. Are we okay?
Yeah. Oh, I'm sorry.
Public comment is limited to 3 minutes per person and will be allowed at the time an item is discussed. Individuals wishing to address the board under public comment are welcome to do so. And now, let's see. Trustee Swope, would you lead us in the Pledge of Allegiance, please?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Judy, can we take roll call, please?
Mr. Kelly?
Here.
Ms. Cavness is absent. Mr. Heschak?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris?
Here.
Mr. Swope?
Here.
Ms. Cubison?
Here.
And Mr. Land?
Here.
Thank you.
Okay, at this time, is there any public comment on any item that is not on the agenda?
There does not appear to be any public comment at this time.
Okay, that brings us to an item that is off our agenda, item 0. And I'm not sure,
You might want to hold off on that.
can I hold off?
Yeah.
Can we move to item 1 then and get her in later? Okay, so that will skip item 0 and move on to item 1, which is the consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Does anybody have any items they would like to discuss or pull from the consent agenda? Seeing none, it's approved by unanimous consent. And that brings us to item 2. And I'm going to pause for a moment here. Proceed with item 2.
Have you got email up?
Okay, proceeding with item 2, which is investment matters and the quarter investment update summary. And I'm assuming we're going to do the full report at the same time. I think we usually do.
Yeah.
Okay, so that's going to be items 2A and B. Colin.
Good morning.
Welcome.
Thank you.
Thank you. It's good to see you all.
Back at you.
Read unsupervised here.
Oh, no.
Okay, I'm trying to share the screen.
Okay, thank you, Robert. Appreciate it. Well, it's good to see everyone. We have a few agenda items we're going to talk to you about today. First is our standard quarterly performance update. There's the monthly flash report as well. And from a performance perspective, you all should feel pretty good. Actually, performance looks really good. The fiscal year ended on beneficial for the plan, and so that's a pretty good report card. Hannah is going to spend time talking about performance, and then we're going to talk about real estate. And as you know, after we do the asset allocation study, we go through and we look at each asset class and ask the question, well, what we're doing today, should we continue to operate as we are? And we're taking a look at real estate now, and we're going to ask the question, well, should we structure the real estate portfolio differently? Do we like our current providers? And at the end of the day, we're going to provide a few different options you could follow. And there's a good likelihood that we'll be conducting manager searches for new and existing providers on a go-forward basis. Okay, so that's what we're going to talk about today. And I'll kick off by just providing a little bit of backdrop of what was going on in the capital markets at the end of June. And so we're looking at on slide 3 here. I need to make it bigger on my computer so I can actually read it. But the quarter ended, and this is the fiscal year end for you too, June 30. And it was really strong returns across the board, which is amazing because remember in the month of April, which is in this quarter, that was Liberation Day. And when we had Liberation Day in April, the market went down meaningfully and people thought, oh no, tariffs mean this is going to be a slowing economy and it's going to be a real problem for the capital markets. But through the quarter, the tariffs weren't quite what people thought they would be. We came up with this new term, taco. Yeah. And or maybe it's just a leverage and negotiating tactic and not necessarily chickening out. Anyway, tariffs are higher than they were before, but they're not as high as people thought they would be. And the global economy continues to grow at this point, and inflation hasn't been quite as bad as people thought it would be, yet at least. So lo and behold, U.S. stock market was up over 10% in the quarter, even though in April it started off pretty rough. On a one-year basis, so your fiscal year, U.S. stocks up 15%. But do note the difference between U.S. large cap stocks and small cap stocks are still pretty pronounced. Now, if I told you, hey, the Russell 2000 is going to earn you 8% return, most people would be pretty happy about that. But it's just that, the large cap market continues to do so much better. Where we stand today, the U.S. large cap market has, if you look at the S&P 500, the broad market, has a PE of about 22. That's pretty high by historic standards. That's a forward PE, right? So how much you pay for each unit of earning is 22 times right now. So that's a little higher than normal. Small cap stocks are at 15 or 16 times earnings right now. So there's a big difference of what the market is paying for a large cap stock versus a small cap stock right now. And perhaps it's justified if those large cap stocks continue to earn more and the growth of earnings is significant, well, that justifies the PE difference. But either way you cut it, it's looking a little higher than it has historically right now.
Is there an index that takes out the Magnificent Seven?
There is. There's the S&P 493.
If there were such a thing, that would be a nice thing to actually gauge where earnings and PEs and such are.
Yeah.
Because it's the Mag 7 that's skewed everything. Right?
Yeah, absolutely. That's absolutely true. And I kind of said that half joking, but there is now. People do look at the S&P 500 X Mag 7.
Cool.
Another thing you could look at is something called the S&P 500 Value Index versus the Growth Index. And the Value Index has a PE of 18 or 19 now, I think.
Even.
So even large cap stocks that aren't the Mag 7 have a pretty healthy pricing right now. Howard Marks, I don't know if any of you follow Howard Marks, he runs a company called Oaktree. He was actually on Bloomberg News this morning and was being interviewed. And that was his point, that he made a couple points this morning that I thought was interesting. One of them is that, well, these are great companies and they're growing great, but a lot of large companies are highly valued now, even those that aren't necessarily growing great. He's a bond manager, so you always got to be careful. Okay, what's his book? Right? So that was one thing. But the other thing is they say, well, what does this feel like? And he said, well, to him, it kind of felt like 97. And that's when Greenspan came out and had his quote about irrational exuberance, right? That was in 97, where Greenspan at the time was the chair of the Fed. And he said, prices are kind of high, irrational exuberance. But that the market peaked 2.5 years later, right? So the old saying, the market can stay irrational longer than you can stay solvent, right? And that's what Howard Marks is kind of saying now. Like, things are getting expensive, but they can get even more expensive over time, right?
How many true tariff agreements have been actually finalized or formalized?
I can't keep it straight. I mean, that's the honest answer. I can't keep it straight. But also, there are agreements, and some of them are agreements, but not necessarily inked. They're agreements in principle. I don't know that I can't answer it. And that's part of in my opinion, the market is looking past this uncertainty right now. But it is kind of uncertain. Like, I don't know what it is. China, they kicked China's tariff agreement down the road again. I think there was some press yesterday that they're saying they kind of like the way things are now, right, in terms of tariffs. Yeah.
Walmart's raising prices based on tariffs. So I'm sort of unsure what you really feel that other companies will follow suit or not.
Yeah, and so that kind of falls through to inflation, broad measures of inflation, right? We could look at that at the next slide here. In the upper right-hand chart, we look at inflation over time, and we've got CPI, PPI, and what happened after the end of this quarter, we came out with CPI and PPI prints. PPI was last week or the week before. PPI is running hotter than CPI. It surprised on the upside. CPI surprised on the downside.
What is PPI?
Purchasing Price Index. Purchasers Price Index. So what that means is people who have to buy things for a company, like they go out and buy goods and services, and then they turn it around into a product that they sell. When you and I buy it, it's consumer prices, CPI. When a company buys it, it's PPI. So PPI gets high because they're already buying the expensive things. They haven't passed it through to us yet.
If the tariffs hit the PPI.
Exactly.
Sure.
Exactly. So that's where you're starting to see it. Will it flow through? What will that tariff be? Still TBD. Now, if you're a company, what do you do if your costs go up? You could either pass it through to the consumer, or it eats into your profit margin. Those are kind of your decisions, right? And to date, companies seem to be letting it eat their profit margin more than passing it through right away. But what they also did is a number of corporations went out and they bought a bunch of stuff before the tariffs became enacted, right? So do you remember in first quarter, we had a negative GDP print, right? So if you look at the upper left-hand chart here, we've got GDP every quarter. First quarter was negative, actually. And that's because if you go out and you buy something that another country made, that's a negative GDP for the U.S., right? Because no one here made that good you spent your money on. Someone else made it, so it's a negative GDP print. So what happened in the first quarter is a bunch of companies went out and bought a bunch of imports to front run the tariffs. So if they did that, they may not need to let it flow through inflation yet. And then we had a big rebound in the second quarter where GDP came in north of 3. What we think, okay, so what does this data mean? There's a lot of noise in here with imports and exports, right? But so we say, okay, let's take those 2 quarters and average them. And that's probably what the growth rate of the economy is right now, 1.5%, which is a little below trend, which is a little below what we want it to be, but it's still positive, right? We're hoping it doesn't turn negative on a go-forward basis. So, but the U.S. economy's been resilient in the face of a lot of this uncertainty. It really has been. Unemployment remains low. But if you dig under the hood of unemployment, who are the people with the highest, unusually high amount of unemployment? It's actually people looking for their first job, right? And there's a lot going on there, right? AI, do I need to go out and hire? Actually, really young engineers and programmers are having a harder time than they did just a little while ago trying to get a job. And it's because that's the part of the economy that's going to move the quickest to use AI to replace the entry-level job. I wonder what's going on in the legal profession as well, right? Of where you could use technology to do things that was kind of a repetitive function historically.
Advisors are killing my business.
Right? So Hannah's generation doesn't mind interacting with a robo, right? For me, I kind of like talking to a human, but I'm old school. Left-hand chart, one other thing we'll take a look at. Let's look at the yield curve over these different time periods. We have way too many lines on this bottom left-hand chart, but what kind of the key thing to kind of focus on in the most recent quarter, the long end of the curve, the 30-year Treasury yield actually went up, and that's more sensitive to changes of inflation and long-term growth expectations. But inflation is the thing arguably that pushed that 30-year yield up, inflation expectations. And then we're starting to see the short end of the curve come down with the idea that the Fed will cut interest rates in September. Right now the market's pricing the first cut in September, one interest rate cut, maybe a second towards the end of the year. And so that's the way the yield curve is shifting right now. So what this yield curve is telling you is that for the quarter, bonds did pretty good unless you held only long-term treasuries, which actually posted a negative return for the quarter, and on a quarter-to-date basis too, where we stand today. Long end of the curve continues to just slowly creep up a little bit. On slide 5 and the next few slides, we spend a lot of time talking about what's going on under the hood in the markets. To me, the big takeaway for the quarter is large cap stocks and growth stocks did better than smaller cap, but strong, robust returns kind of across the board. And information technology, again, led the way in the first quarter. International markets did well in the quarter. Okay. A big component of this is also currency. The US dollar depreciated on average about 10% on a year-to-date basis. So that's another thing that's going on with if our interest rates go down and if there's less interest in investing in the United States, there's less demand for the US dollar. Right? So the US dollar has been depreciating on average. China's had a spectacular one-year run, up 33%. The fixed income market, here you'll see kind of reasonable returns for the quarter, except for long governments. We kind of touched on that. And that's important for us if we have a deficit continues to grow, right? How do you fund the government? Higher interest rates, it's more expensive to fund the deficit. And then we've got the real estate market in slide 8. Decent returns for the quarter. Decent returns from mostly coming from the income or the operating of the properties. Not so much for appreciation or depreciation. So all in, Hannah will get into it. You're kind of close to an all-time high in assets. Returns look pretty good, but we've been to the ups and downs of this over the years. Right now, you're certainly at a high point. So unless any questions, turn it over to Hannah, who can talk about.
One quick question. Were you predicting, or would you predict that there is going to be a rate cut, interest rate cut in the next quarter here?
I
I
think
thought I
it's-
heard that.
Yeah, most likely in September.
Okay.
Most likely, but so the feds this week they're meeting up in Jackson, Wyoming, right? So the Fed does this big offsite once a year. So Powell's going to have a speech, maybe today, tomorrow, and then he'll probably nod a little bit which way they're looking, but probably interest rate cut in September.
Okay, great. If there's no other questions, I can start talking about the portfolio. So on slide 10, we look at the overall MSARA plan growth over time. As Greg mentioned, we've hit a new high water mark at $793.5 million. The table at the bottom shows the fiscal year. So as of the end of the previous fiscal year, the portfolio was about $715 million. So we've seen almost $88 million in positive investment returns over the fiscal year, and then about $10 million in benefit payments leave the plan. On the next slide, we look at the actual portfolio versus target. The portfolio remains right close to target within policy guidelines. We're slightly underweight domestic real estate and fixed income, and then slightly overweight infrastructure and equity, but all within tight within target. On the next slide, we look at how the target has changed over time. You can see the orange was the addition of infrastructure, and we've taken a little bit from equity to fund that over time. Versus peers, this slide shows the asset allocation for the peer group in the different asset categories. Domestic equity, domestic fixed income, international, and real estate being the most popular, which the plan is invested in, along with some diversified real assets, which is coming from infrastructure. Looking at the asset allocation within the individual asset class categories, the total portfolio was up to $793.5 million to end the quarter. This table just shows the previous quarter when we were looking at the fiscal year on the previous slide. So just in this last quarter, we saw $55 million in positive investment returns. So that's that third column in from the right. You'll notice it's all in black, which is all positive. And then in the net new investment column, you'll see some activity, particularly in international equity. As you all remember, we did the international equity structure. We did those two searches. We hired Brandis and Artisan, and we moved passive in the core space within international. So you'll see that Europac, Harbor, Oakmark, and Mondrian are no longer in the portfolio, and we have the State Street passive index, which is about 63% of the international, and then you have Brandis, which is the more value-oriented international manager that's complementing T Rowe, and then Artisan, which complemented the existing manager that we have with 91. So this is will be, I think, the index was funded in April, and then the international small cap and EM funds were funded in May. So we don't have a full quarter's worth of performance, but June was our first month with completely switched into the new portfolio. Looking at performance on the next slide, Greg already stole my punchline, but it was a great quarter and even better fiscal year. For the last quarter, the portfolio was up 7.52% net of fees, outperforming the benchmark return of 7.43 and ranking in that top quartile versus peer, so ranking in the 22nd percentile. For the last year, your 2025 fiscal year, the portfolio was up 12.33%, outperforming the benchmark's return 11.88, and ranking in the top decile. You'll actually notice that you're off the charts for the last year. So really strong last fiscal year and quarter. And then strong long-term results too. You're annualizing 7, 8, 9% over the long term.
So that includes all the fees?
Yep, net of fees.
Investment manager fees.
Yes.
Yeah.
Yep.
Thank you.
Well, are there other fees?
Well, you pay people like your actuary, your custodian, Callan. Yeah. So there are other fees, but this is net of investment manager fees.
Right, those others count mostly as part of our administrative budget fees as far as some of the routine consulting by the actuary, although the valuation is actually charged as an investment expense, but these returns are just net of the investment manager fees.
Thank you.
We can move to slide 20, please. Slide 20 shows total fund relative, sorry. So this slide shows the total plan performance and the individual at different asset category composite level. So like I mentioned, total fund up 7.52 versus the fund target at 7.43. And within the individual asset categories, domestic equity was up 10.4%, does trail the Russell 3000, which was up 10.99. And that's because we have a tilt towards smaller cap stocks relative to the Russell 3000, and the domestic equity market has been dominated by the Mag 7 and those large cap stocks. For international, outperformed up 13% versus 12% return to benchmark, and really strong returns for the past year. International markets up almost 20% versus domestic stocks, which were up about 15%. Fixed income has outperformed over all time periods, up 1.3% for the last quarter. Really strong bond returns over the last year, up almost 6.8% for the last year for bonds. And then you have infrastructure and real estate, which have both been very additive for the portfolio. Infrastructure outperforming for the last quarter and year. And then real estate was underperformed by a few basis points just for this quarter, but it has had a strong comeback this past year, up 3.3% versus 2.5% for the last year. Yep.
Can I ask another question? Hey, going back to slide 18. And I think that one, right. And looking at that, it looks like our risk is a lot higher than what our targeted risk should be.
So your total fund target is comprised of benchmarks. So those are not active managers. So it's a passive implementation where your total fund, you're using active managers to try to get that return, which comes with a slightly higher risk.
Yeah, and additionally, that's a 15-year snapshot. And over the years, we have slowly changed the risk pattern of the portfolio. So way back in the day, you really didn't have a lot of real estate or infrastructure. And it was very U.S. equity centric. And over the years, it's become a more diversified portfolio. But I mean, really just on the margin with the addition of infrastructure. If you look at the calendar year returns on slide 16 and 17, there was a phenomena where the investment program, for a while, you were either ranking really high or ranking very low. And it was a phenomena where the equity market was just giveth or taketh with the investment program. So I'd say thematically for this group over the past 15 years, 10 to 15 years, you've slowly tried to take in the risk profile a little bit. And Robert flipped to page 17 there, and that's a pretty good example of where, calendar year 19 and calendar year 17, you'll see that they were like pretty decent sized moves. And that was part the beta, if you will, the equity allocation, but then also the managers were either adding a lot or not adding a lot over those time periods. I should mention fiscal year 2016 as well. So kind of like the broad arc of the investment program, that's changed a little bit over time. And what the number that we're looking at there on that chart is a 15-year, a total of 15-year time period.
So that on 18 again, that is basically 1.25% difference between the two risk factors on a scale of 100%, or if you put that all the way out, is that significant?
Yeah, I think that's a good point. Like if I told you you're running at a volatility of 10 versus 11, it feels the same to you. Right? It largely feels the same, but we do want, we'll take lower risk if we can get it. If for the same return, we'll do that all day long, right? But experience-wise, it feels pretty similar to you.
That's about a 10% increase in volatility,
Yeah.
which is not that much. I think Hannah wanted to go to page 9. What I'm seeing as 19.
I'll go wherever you want me to go.
Sure,
When you
yeah, I was
When you
just.
called out 20, I went.
Yeah, I mean, so this one just shows total fund attribution. So it shows, so the top chart is for the 1 year, which is your fiscal year, and it shows what's driving the outperformance relative to the benchmark. We split it into 2 buckets, and the green rectangle is your manager effect. So how are your active managers providing value over their benchmark, and then the asset allocation. How are deviations from your policy target either adding or detracting from performance? So for the 1 year and the 5 year, you've outperformed the target, and it's mostly due to that manager effect. So how your active managers have outperformed the benchmark. For the last year, international equity was the standout, as well as fixed income, and then for the 5 year period, infrastructure and domestic fixed income were especially additive. I can go from there to slide 25 if you'd like to look at the individual managers within domestic equity. Domestic equity, as I mentioned, was up 10.5%. Large cap is passively implemented, so that's with your S&P 500 index. And then you have dedicated allocations to mid cap and small cap. And then within mid cap was up 8%. It did trail the Russell Mid-Cap Index by about 50 basis points, and that's due to Janus. That's the mid-cap growth strategy. It underperformed for the last quarter. For the last quarter, the Russell Mid-Cap benchmark was up 18%. So mid-cap growth stocks in particular had a very speculative rally and a very narrow market leadership. The top 10 stocks in the Russell Mid-Cap accounted for 59% of the return. There was one name in particular, Palantir. It's a software analytic company that was up 400% for the quarter. And then the index was just reconstituted at the end of June, and that rolled out to the Russell 1000 because it's now has a $300 billion market cap. And Janus did not own that stock. And it was 8% of the index, so had a significant impact on performance. And then Fidelity Low Price Stock, that's the other mid-cap manager, did really well. They have about 38% of the fund in international stocks, which really helped them over the past quarter and year. And then small cap did well, up 10.5 versus 8.5 for the benchmark. Both Prudential, the small cap value, and AB, the small cap growth managers, outperformed, ranking in the top third of the peer group. So really strong returns for those managers. For international, on slide 28, as I mentioned earlier, you now have implemented your new international portfolio. We don't have a full quarter's worth of returns, so I added a new column just for this last month so you can get a glimpse. But for the last month, the international portfolio was up 4% versus 3.4 for the benchmark, outperforming. You now have 64% in that passive SSGA World ex-US Index, and then you'll have your dedicated international small cap with T. Rowe and Brandis, and then your EM allocation split between 91 and Artisan. So this is your first full month with Brandis and Artisan, and both of them significantly outperformed. So far, so good. And then lastly, well, I guess not lastly, but next is fixed income. Fixed income has done really well, up 1.3. Both, Dodging Hawks outperformed, PIMCO trailed by a few basis points, but together they've done really well over all time periods. And then we have infrastructure and real estate on slide 34. Real estate up 80 basis points. Barings had a strong quarter and strong year. And then Reef slightly underperformed due to their overweight in industrials and the West Coast. If you read Robert's memo, he went into great detail about their performance. And then lastly, slide 35, this is our manager monitoring summary. We removed the managers from international that were there previously, and now we have your new managers. Overall, things are in pretty good standing. Bearings, we note that PM change that we talked about at length of last meeting. That's why they're highlighted yellow, as well as some previous performance struggles. And then the only new addition was the T. Rowe Price. They announced some firm-wide layoffs, doing some cost improvements, but no investment professionals were affected. It was more back office, but something that we're just monitoring.
So I have a question about the fidelity note here. It's, how long you think that's going to be highlighted and called out?
Yeah, Claire and I talked about that too. Yeah, we were considered removing it, considering it was from back in 2023. But so far, we don't have any concerns. They've done well. I think it's just something that we've kept on there just so we don't forget.
I'm sorry, which?
Just the Fidelity low price stock
on
PM
slide
change.
35, this has been called out, the transition from the previous
Okay.
portfolio
Fidelity
manager
low
to the
price.
new folks.
Okay.
So, my question is, how long do we need to be concerned about that transition?
I don't
Sounds
think
like
it's not a
be
concern
changing.
thing, but I think so if the transition happened in 2023, wouldn't they have like a 2-year track record? So maybe once it gets to 3, we'll just remove it at that point. But yeah, I don't think it's anything of concern.
I think specific to that strategy, Joel Tillinghast, who retired, was really the architect of the strategy, and it was pretty unique under his purview. So we've given it a little bit longer runway
Can
in
you?
monitoring the transition.
Is that picking up on the microphone when you speak back there?
No, sorry.
Oh,
We could just repeat that. The importance of that portfolio manager was pretty high, Joe Tillinghast. And so I think we're just staying patient. And sometimes, what's the upside of taking them off versus the downside, and something bad happens. And but at some point, I think it's warranted to take them off this soft watch in the future. I think it's a fair point, Robert.
Any questions on performance before we transition to real estate?
Is it the intention to go straight to the real estate portion at this point when we do have items C and D?
I did want to go to C and D just very briefly.
Okay.
If you'll
Before
entertain.
you do, would this be a good time to see if Catherine is ready?
It does not appear that she's going to be able to.
Audio and video check, she's on the screen.
Oh, all right.
And she's
Catherine, I think she's away from her screen. She had indicated she was having some issues because she couldn't get audio. I don't know if she was going to plan just to watch or.
Okay, well, we'll circle back on item before we start item F. Yeah. Okay, let's proceed with item C then. Robert Revelis, this is preliminary monthly investment performance report.
Thank you, trustees. You've got the preliminary monthly investment report here. We've also got the quarterly updates. We can kind of combine all these briefly. Really, I wanted the trustees to focus on the real estate memo, where I've laid out and sort of talked about some of the market dynamics that are happening within two important sectors of the real estate landscape, one being industrial and one being residential. Very briefly, the industrial sector is being impacted in certain specific markets in both positive and negative ways. Industrial demand is relatively low compared to recent history. There's a high availability. The COVID shock that was experienced in other sectors was experienced in the industrial sector, and at this point, the demand is low. And so certain regions that I mentioned, Orange County, Riverside, and LA, are very challenged markets when it comes to industrial. There's been a big build out. There's a lot of warehouses that businesses have the option to move into. The final thing, nobody really knows what's going to be happening with tariffs, but one of the final thoughts that I leave off with when it comes to industrial is the potential headwinds related to Chinese tariffs on the West Coast and potentially a tailwind on the East Coast, depending on how the supply chains reorient themselves. So that's something I just wanted trustees to be aware of. In the residential side, the sector has some tailwinds. The lack of affordability, demographics, and general demand are being shown through a very high level of absorption. In addition to that absorption, construction starts are dropping precipitously. Affordability, as you're probably aware, has also been impacted. I linked to a few reports related to some of those dynamics within the residential market. And the final issue related to residential is demographics, changing populations, where people are migrating. And people are most definitely migrating into the Sun Belt and the Mountain West region. So those are a few items that I just wanted to call out as we continue discussions here and we look a little bit deeper at what Callan's bringing forward for manager search and review. And that was really all I wanted to call out. There's, of course, the infrastructure memo. Trustees have that memo. I'd be happy to answer any questions you might have about either one of those.
Are there any questions for Robert at this time? Seeing none, did I cover all three of these items then? So that will bring us to item F. And what I said about item F was that before we started that, we would make another attempt to bring Catherine in.
I don't think that's going to be possible at this point in time.
Okay. That's unfortunate. We'll work on the technology for the next time this comes up. That brings us to item F, Callan real estate update.
Great.
There they are.
Little musical chairs there, yeah. Great. So continuing the discussion on the investment portfolio, we're going to spend the next segment here focusing in on the real estate portfolio. So starting on slide 3, we have a snapshot of your total real assets portfolio. At the last quarterly meeting, we started this discussion and we're continuing it today. What should we do with the real assets portfolio? We did kind of a review of what you have last time and discussed any possible changes. To kind of level set where this fits into the total portfolio, the pie chart on the top right looks at your total portfolio, what Hannah just reviewed, by asset category. The largest components of that pie chart are your public equities, so the dark blue being domestic equity, the green being international equity. We worked through each of those asset categories earlier in the year and last year, and now we're focusing in on the light blue and the orange. That's your infrastructure and real estate, most specifically real estate today. What that means in dollar terms for your portfolio is on the left-hand side of the page here. So the real estate and infrastructure portfolios together represent about $130 million of the total portfolio. Real estate being about 70 million of that, and then infrastructure at about 60 million. How we currently implement the real estate and infrastructure portfolios is each with 2 core open-end managers. So the total allocations being split evenly between 2 managers in each category. For real estate, your 2 managers are Barings and DWS Reef, and then within infrastructure, you have IFM and JP Morgan. Flipping ahead one slide. At the last meeting, we talked about each of those portfolios, real estate and infrastructure, from kind of 2 perspectives, 2 components of the review. The first being reviewing each of the individual managers to assess or reaffirm our conviction in your managers on a go-forward basis. And the second piece of it was to really talk about the structure. Is this the structure that we want on a go-forward basis, or do we want to consider making any changes? The conclusion of that was that there was agreement to do 2 searches. So to continue the discussion by asking Callan to do a core open-end manager real estate search, as well as a core plus manager search. For the infrastructure portfolio, we talked about the managers, we talked about the structure, we agreed we're comfortable with that on a go-forward basis. So we're really, again, focusing on real estate today. Why did we do a core manager real estate and core plus? When we talked about manager conviction within your real estate portfolio, we did discuss potentially replacing Barings. So there wasn't a conclusion on that. You can choose to keep Barings, but given some past performance challenges as well as some organizational changes, personnel changes, we thought it would be good to do a search there and include Barings in that search. Let's evaluate Barings within the context of the opportunity set there. And then Core Plus would be a new allocation. So doing a search for a new manager with a new allocation within the portfolio. And if we flip ahead one slide, we capture kind of the 3 options that we talked about from a structure perspective. So option 1 that we've outlined here is to keep the status quo, keep what you have. You have your 2 infrastructure managers and the 2 real estate managers, DWS and Barings. Option 2 would be to potentially replace Barings within the same structure. And then option 3 incorporates that new allocation to Core Plus. Now, admittedly, option 3 is kind of 3A or 3B. You could choose to replace Barings or keep Barings within that structure. Our inclination is to lean towards option 3, but that decision doesn't have to be made today. So what we're doing today is looking at the 2 manager searches that we conducted, 1 core and 1 core plus. And the decision that needs to be made is which fund managers would you like to interview? You can say we want to interview all of them. We think that that's a very reasonable go forward. But let's talk about each of the finalists from those searches. The core search, which identified 2 managers plus Barings. And then the core plus search, which identified 3 new managers, 3 core plus managers. So I'll pause there and take a breath to answer any questions as we move forward in the discussion to look at the individual managers and the searches that we conducted.
Are there any questions up to this point? Not seeing any.
Okay. Then I'll turn it to Aaron to walk through the searches.
Great. Before we jump into each of the searches, we added this slide here to kind of provide some context around the NCREIF Odyssey Index. There's some industry jargon that we want to just define here. So the Odyssey Index is the benchmark which I think you're familiar with. You see that in the reports. What it is it's both a performance benchmark as well as a composite or a peer group. So there's 25 different open-end diversified core equity funds, including Barings and Reef, that are included in this index. So we use it not only to benchmark your performance, but also to compare to the opportunity set. So you could be invested in Barings and Reef today, but there are 23 other funds in that index that offer a comparable strategy that we consider to be the peer group universe as well. So the bottom box on the left in the teal talks about some of the different criteria that is required of these funds in order to be a constituent in the Odyssey Index. We don't have to go through all of these, but really the idea is that these have to be really core strategies. Invested in the US, invested in kind of major property types primarily, with the ability to invest in some alternative property types. And they need to be pretty core assets. So when I say core, I mean relatively new assets in major markets, well leased, rather than kind of brand new development or a lot of vacancy. So that's the kind of real estate that you're owning in these portfolios. On the orange box on the right, we talk about the appraisal process. So each quarter, these assets are valued. Once, in general, it's an independent third-party appraiser that's responsible for these valuations. So there's less of a concern of your manager saying this building's worth $100 million when in fact it's only $60 million. There's an independent process to kind of prevent that. And each asset is valued quarterly. So once a year, it's done kind of a full appraisal where they come out and individually value that asset. And then in the interim quarters, it's kind of a desktop appraisal, if you will. So that's just some general context around, the private real estate market and what we're talking about today. No questions there. I'll jump forward and we can talk about.
I do want to just mention to the trustees that the fourth bullet point down here on the left-hand side is probably one of the biggest, that at least 75% of these funds are in these core sectors: office, industrial, residential, retail. And as Aaron mentioned, they have to be at least 75% leased, this kind of stabilized factor. And then, the final call out, I would say, is the leverage that these funds would be having. As far as the appraisal, I would also remind trustees that while they do have these third-party appraisals, usually within the valuation policy, the company has the option or ability to potentially override those values. That's rarely done, from what I've seen, at least with the R2 managers and what I've come to understand about these other strategies here. But it is certainly a possibility. And in between all those annual external valuations, those valuations are done internally by their team to sort of check for consistency, like Aaron was mentioning.
So the leverage ratio basically is 65% owned outright. Is that?
No more than 35%.
Yeah, and our two funds are in the mid-20s at this point today. And some of the other funds that we're going to look at, the Core Plus, they're in the 30s, low 30s, maybe high 20s. But that's the real defining characteristic: 75% in these core sectors and leverage.
So in that same question, is what they're paying for the leveraging considered in all this analysis?
Yeah.
Okay.
So all the returns are net of investment expense, right?
Yes. That's right.
And in the larger decks, Callan does call out some of those metrics, 5%, 5.5%, 3.9% average debt rates.
Great. So with that context, maybe we'll jump forward to slide 8 here. And this kind of sets the stage for the core real estate search. And so as Claire mentioned, there are two different searches we're going to talk about. First, we're going to focus on core. We'll walk through these 3 candidates, including Barings and kind of the process to get here. And then we'll move on to Core Plus. So at the top, this sort of box of 8 candidates, this is what we initially brought through Callan's manager search committee. We started at the 25 groups and then eliminated funds that either weren't a fit because of underperformance or, personnel turnover, organizational challenges, and that led us to this group of 8. Once we got to manager search committee, our committee helped us narrow down that list to Barings as an incumbent manager plus 2 additional managers. Sure, question.
When you did this evaluation, did you evaluate Barings, or did they get a pass on this cut due to the fact that they're an incumbent?
The latter. They're included in this
Okay.
as an
So no
incumbent.
matter what they were relative to the other ones, they were going to make it onto this list.
That's correct.
Any idea if they would have been cut if they were not an incumbent based on the criteria that you have here?
It's a great question. Based on long-term performance, that has definitely been a challenge for them. And then additionally, fund size. There are other funds of a similar size as Barings that we think in a fresh search perhaps would not give you the diversification that you'd need relative to some of the other candidates. So to answer your question, I believe Barings likely would not have made it through manager search committee if included as not an incumbent.
Thank you.
So once we get to these, 2 managers here with LaSalle and Principal, which we'll talk about in depth alongside Barings, our position is once we get to this point, we have conviction in both managers. Both are groups that we know well. We think the funds are well positioned. We have conviction in the teams. And so really what we're trying to do today is just help differentiate them and give you a sense for, the teams, the strategies, how they look different from one another and how they might fit in your portfolio. So if we move forward one slide here, we have this sort of summary matrix that stretches 2 pages. I know it's a lot of words here, a little bit of a small text, so I'm going to try to walk you through it, and then we can maybe just refer to some of these points. So Barings, obviously, well, so I don't necessarily need to walk through some of the characteristics there, but I do want to highlight some of the differences between Barings as you think about LaSalle and Principal. So first, I would say both LaSalle and Principal, if you look at the inception date row, long tenured funds. Principal going back all the way to 1982. This is the second longest tenured fund in the Odyssey Index. And LaSalle, starting back in 2010, we've got 15 years of track record data for them now. The same portfolio manager since inception. So a lot of consistency sort of through their tenure, despite relatively shorter track record than Principal. Although 15 years is still very substantial. Just below that, we look at the fund size. So on a net asset value basis, where Barings is about 1.9 billion. LaSalle is 6.2 billion and Principal is 7.3 billion. So both are meaningfully larger than Barings, but within the context of the Odyssey Index, I would consider them both to be sort of mid-sized funds. Your other manager, DWS Reef, is about 11 billion, and the largest Odyssey fund is 30 billion. So there are definitely larger funds out there, and there are some benefits and some drawbacks of larger funds, but we think these mid-sized funds could potentially, pair well with the larger size of DWS Reef and also give you substantial diversification across different assets in the funds as well as across other investors that you would be invested alongside.
So Aaron, not necessarily specific to Barings' size, but smaller funds like Barings, 2 billion. Do you have concerns related to the smaller funds within the Odyssey in general, just related to size alone?
Yeah, I think smaller funds, some of the challenges that can come with that is you might have several, a handful of poor assets or poor performing assets that can really tank the, performance of the fund. In some cases, Barings, for example, had 4 central business district office buildings in gateway markets where the market turned on them, and just those 4 assets had a really significant impact on the performance. Whereas if you had a larger fund that was more diversified across different markets and different sectors and different assets, you could avoid some of that, or at least that underperformance would be diluted by the performance of the rest of the portfolio. The other challenge is the number of investors that they might have, or the size of those investors, where a smaller fund that's $1 billion, $1.9 billion. If you have, one client that's $200 million, for example, and they choose to redeem, or a handful of those larger clients choose to redeem, it can really put the fund managers in a different, difficult position, as opposed to a much larger fund where there's more diversification of investors.
So concentration of assets really being one side, one concern, and concentration of investors being on the other.
That's right.
So, into that comment and the issue that I guess you haven't gotten here yet, we've got a $600 million execute with Barings. How long does it take us to get our money out of there?
Yeah, so Robert noted this in his memo, but the queue has come down a little bit. We have the number as of July 1st as 443 million. I think Robert's number was a little bit lower after accounting for some other changes since July 1st, but we've got at 443 million. So they're making some progress on it through asset dispositions to pay down some of those redemptions. They're quoting, I think, 2 to 6 quarters to fully extinguish that queue. But I think, with some of those projections, first of all, that's a pretty wide range, 2 to 6 quarters. And also it's dependent on kind of the market cooperating with them to be able to sell these assets. And there's also the assumption of some rescissions of redemption requests that's kind of baked in there. They may or may not get those rescissions also.
Can you explain to me what the entry queue is and whether we should be concerned? That would look like perhaps no entry queue would not be a good thing. I would interpret that as new investment. So they have a lot of people pulling money out, but very few people putting money in. Whereas the other two candidates, LaSalle and Principal, have significantly more money coming in. Now, why does this send into an entry queue in the first place? They're unable to. They have to actually buy properties. So they're not ready yet to buy. So it sits there. Does that mean that you have not bought your shares yet?
That's exactly right.
Okay.
Yeah. So the entry queue is indicative of kind of inbound interest in the fund. So seeing an entry queue versus a big exit queue and no entry queue, yeah, that's a positive thing. But what we want to avoid is a significant entry queue where you're stuck behind hundreds of $1 millions of capital and your capital won't be called or deployed for several quarters. So in both of these instances, relative to the size of the fund, these are not entry queues that we're concerned about where you wouldn't be invested for a year. You're very likely, if you were to make a commitment today, for example, 2 quarters, you'll be fully invested is kind of the guidance that we're getting from these managers.
I would also note for trustees that there was an interesting table that Callan provided in the longer deck, in the longer search book, that showed that exact metric for each one of the managers. Barings has had smaller commitments recently. I think they were around 7 million, maybe something like that. So you can look at that table for LaSalle and Principal. They've dealt with some of those queues. A few years ago, it looked like in 23, LaSalle, I'm recalling, had large redemptions. I don't know the details of the redemptions themselves, but trustees should know that there is a table in the larger search book for that exact information.
Great. Moving along, I just want to comment quickly on the portfolio management teams for LaSalle and Principal. Jim Garvey, as I mentioned, is the portfolio manager for LaSalle. He's been with the fund since inception. He's had a deputy portfolio manager under him, Frida Dell, who has been working on the fund for 5 years. She recently took a medical leave of absence. She's expected to return to the organization, but in the interim, they brought on a co-portfolio manager alongside Jim Garvey, who he was previously the head of acquisitions. So very senior person within LaSalle, but new to portfolio management. And then they're going to add a deputy portfolio manager as well. So, there have been some changes, but we feel, we continue to have conviction in this team and this strategy, given Jim Garvey is still there, and also the senior resources that LaSalle is allocating to this fund, kind of indicative of the importance of this product to their platform. And then on the Principal side, there's a co-portfolio manager structure. Darren Kleiss has been working on this fund for I want to say probably a decade or so. Kyle Elfers joined the team as a co-portfolio manager 2 or 3 years ago, and he also came from the acquisition side. And then there's an assistant portfolio manager, Bridget Lechtenberg, who supports these 2 senior portfolio managers. So we like the team portfolio management structure. That way, if somebody leaves or retires or, again, medical leave of absence, something like that, there's still that continuity where they're not scrambling to find somebody to replace them. So confidence in both of these teams, but I did want to call that out specifically. On the next slide here, we go through some of the characteristics here. Really, there isn't a ton that differentiates these 3 funds here. On the top, we have some characteristics, but I want to talk more about kind of the sector weightings and the regional weightings as we get to the next couple of slides. And then fees are another potential differentiator that maybe we don't necessarily want to focus on too much now, right? We want to determine the best fit for the portfolio and then maybe talk about fees later on, but we do have a slide in here that kind of compares the fee load across each of these funds by commitment amount. So if we could move forward to just one slide here, this is a property type diversification. You'll see Barings in blue, Principal in green, LaSalle in orange, and then in this, what is that, gray? Tan. That's the Odyssey benchmark. And so what I want to point out is kind of the significant differences here. Let's start with residential. They're all about the same. The difference that you'll see there is kind of what type of residential they're invested in. So both LaSalle and Principal have a little bit more alternative residential exposure in the, and that's in single-family rentals in both of those funds. And Principal does a little bit of also, manufactured housing and some student housing as well. In office, you'll see both Barings and LaSalle have a meaningful underweight to office today. Barings was previously overweight to office. They've moved on from those 4 office properties, and that's helped bring that allocation down significantly, which has been really beneficial for their performance. Principal is about 15% office, which is right in line with the Odyssey Index. What I would note there is that their office exposure is meaningfully different from that of the Odyssey. So what they have in this fund is not New York City, Midtown Manhattan office or downtown San Francisco office. They have 13 office assets, and 87% of the value of those assets is in what they call growth markets, so non-gateway markets. Just to give you a sense of that, their 2 largest assets are in Austin, 100% leased Austin building to Google and Deloitte, brand new construction tower right off of Lady Bird Lake. And then their second largest building is in Seattle, but it's in Bellevue, so on the east side of the water, which has done a lot better than downtown Seattle. And that's 100% leased to, 88% leased to Salesforce, some other sort of high credit tech tenants. On industrial, all 3 of these are, relatively high industrial weighting, with LaSalle being slight underweight to industrial. That's come up in recent years, and that's largely a result of having this higher other allocation. So you'll see on the far right here, that other incorporates medical office, life science, self-storage, and some other alternative sectors. So LaSalle is one of the funds in the Odyssey that has a higher weighting towards alternative sectors, and the industrial underweight is sort of just a result of that. If there are no questions on the sector diversification.
Just one quick question on LaSalle and having that in other. Would that beginning to qualify them? And I don't really understand the difference between this core and the core plus thing. Would that be leaning them towards more of a core plus posture, having those alternatives?
Yeah, it's a great question. When you think about the criteria earlier, we talked about at least 75% invested in the 4 major property sectors. There's a little bit of nuance there because some of these sectors that are in other kind of get rolled into the main property sectors. So like residential, for example, includes single family rental. So there's a little bit of nuance there. So it's not as though once they hit 25 in that category, though they will no longer be in the Odyssey. Sure. But to answer your question, this 9% for the index, so Odyssey index having 9% in alternatives, that's double where it was just 4 years ago. So this has been a trend that we've seen across private real estate, where we're seeing a lot more adoption of alternative property sectors. And so what we see from LaSalle is not necessarily them being a higher risk strategy, but more kind of earlier adopters of some of these sectors where they have a little bit more expertise or have been invested in these sectors earlier. We see some of that from Principal too, although they don't quite jump off the page in terms of their allocation. They have been investing in some of these sectors for quite some time. So it's more of a long-term trend of adoption of alternative sectors, and we're going to see that more from all Odyssey funds. We're seeing it from Barings as well.
And the other category within the Odyssey, I think, is mostly self-storage. Like
That's
maybe half of it, right?
Yeah.
I mean,
Okay.
yeah.
So that is considered to be an Odyssey
Yeah.
type of an investment.
Absolutely.
And we'll talk more about kind of the differences in Core Plus, because a lot of those candidates in that search are, I would say 2 out of those 3 candidates are very focused on alternative sectors. And we'll talk about, they have somewhat of a core strategy at the asset level, but are a Core Plus fund as we think of them in this search due to that exclusive focus on alternative sectors. So we'll get more into that as well. Just
Well, so, and let me make two more. You say a lot about this now. There's a whole lot of nuance and detail within each property sector and region and even market, right? I mentioned that in my memo. But the, when you think about the sectors, since 23, retail's been the strongest performing sector just broadly. And the period for the decade before that, it was really industrial. The changing dynamics of the other sector within the Odyssey, this additional adoption of managers going towards things like life science, the self-storage, the medical office, those alternative sectors seem to have bright prospects. So those are good sectors that we maybe would like to lean into. These other sectors, the potential retail sector, and frankly, I'm hesitant on the industrial sector. It's had this long bull run. There's a huge overflow of availability right now that's going to have to be worked through for the next 2 years, maybe longer. So something to just consider.
Yeah, with regard to the other sector, we think of this as kind of a skate to where the puck is going opportunity, where, if Odyssey is 9% alternatives today, there's, compelling reason to believe that's going to be increased to 15% or 20% in the next several years. So the opportunity with this search is to, maybe get ahead of that curve in some ways with manager selection. Just on the regional diversification, really, there's no significant difference between each of these at a high level, but as Robert was saying, there's a lot of nuance with these regions, and they break down into subregions and then markets and submarkets. With Principal, I kind of said the punchline already, which is that they're more of a growth market focus rather than gateway market focus. So when I say gateway, I mean New York City, Chicago, DC, Boston, LA, San Francisco. Their focus is more on that sort of next tier markets, Austin, Phoenix, Dallas, Charlotte, Nashville, those types of markets. And then LaSalle, you see a little bit of that as well, somewhat of an orientation towards some of those other markets. But I think a lot of that is a function of their focus on alternative sectors where, if you're investing in medical office buildings, it's less important that you're in a central business district office location, but it's more important you're close to a health system, right? So you might be in Minneapolis, for example, where you wouldn't be there for office, but you'd be there for medical office. So with that, maybe we'll move to performance. Again, a lot of numbers here. So the highlights, so you'll have the 3 candidates at the top, starting with Barings, LaSalle, Principal, and then you have the Odyssey Index in that gray box. Barings, we talked about this earlier, has performed quite well over the trailing 1 year. So you'll recall they went and took a lot of pain in their valuations and then sold those office buildings. And since they've done that, their performance has really benefited from some of their dispositions that they've made. The other 2 funds, and then longer term for Barings, we still see some underperformance as a result of some of those prior portfolio allocations.
When was that reevaluation again?
Their office dispositions.
Sort of reevaluation.
2013 or 2023?
22 and 23, yeah. So they started to take those write-downs in 2022 and then made those sales in 2023.
So within that 3 year where they really are hurting.
That's right, yeah.
Thank you.
And then for LaSalle and Principal, there's some sort of near-term, I wouldn't really call it underperformance. There's kind of marginal underperformance or just some noise in the performance numbers. But long-term, both LaSalle and Principal perform pretty well relative to the benchmark and relative to the peer group. I would say with Principal, they are more of a fund that doesn't take significant bets, sector-wise to the index. So if we were to put Principal's sector allocations next to the Odyssey allocations, they're really pretty similar, right in line. And so what that results in is they're not usually going to be a top decile performer, and they're not usually going to be a bottom decile performer. So that's kind of how I would think about this performance here. If they're underperforming by, what is that, 25 basis points over a 3-year period, that may not sort of jump off the page as you think about kind of the 25 managers. That would put them maybe 3rd quartile. But that's kind of what you'd expect from them to be second or third quartile in some cases, but they're not going to be sort of a bottom performer, at least is what we've observed historically. And you'll see that also in the calendar year numbers on the bottom side of the bottom half of that chart. So that's kind of the highlights of performance. I think we've got one more slide on core real estate on slide 15 to talk about fees. And we have this in this, oh, sorry. go
Aaron,
ahead.
before you go there,
Yeah.
on slide 14, you can look at some of these 3-year rolling periods, right, which is important for consistency. And so, trustees should note some of the performance on those rolling 3-year periods before the rate hikes started in March of 22 and before they started to impact valuations in September of 22. And you can judge the performance on that page, those 3-year periods for yourself. Just wanted to point that out.
On these calendar years, the one standout to me is LaSalle in 22. Do you have any explanation for why they so much outperformed everybody else?
Yeah, I think a lot of that is their overweight to alternative sectors. Yeah, they were early in those sectors. They had more exposure than others, and as we started to see more adoption of life sciences, for example, in medical office, valuation or appraisers started to make adjustments to those valuations, so they benefited from that more because of their allocation there.
Okay.
But Robert was referring to the charts on slide 14, which is the 12-quarter rolling returns. So just on fees here, the way we've kind of laid it out is the managers on the left here, so Barings, LaSalle, Principal, and then across the top of the columns there, you'll see different hypothetical investment amounts. So starting from 20 million on the left and moving over to 40 million on the right. So you'll see the different fees, both in percentages as well as in dollars that you pay on an annual basis to each of these managers. Generally, they're all pretty similar in the same ballpark. Barings does appear lower here because of their performance waiver, and we have some notes there on the right. It might be a little bit hard to read, but essentially they're waiving 10% of their management fee for the periods that they generate a total gross return of less than 6%. So because they have not hit that bogey, they are basically giving you 10% off of fees. So this fee schedule reflects that. If they were to meet that bogey, their their fee load would look very similar to the other two candidates. So I don't think there's a big decision to be made in terms of fees, right? We want to make the best portfolio fit decision, and the fees are going to be pretty comparable across all three. And then just on this bubble chart on the bottom, we just showed all three managers are very core. The y-axis is fund size, so you have Barings as a slightly smaller fund, and then LaSalle and Principal kind of mid-sized funds above that, but they're all very squarely in the core bucket. So that's all we had for the core real estate search. Happy to address any questions or talk about anything specific with each of these managers before we move on to Core Plus.
If I can.
Question?
Yeah, on the larger report for core, I think it's buried on the last page, but LaSalle is the only one that's not an investment manager client of Kellen. Is that correct? The other two pay Kellen for services?
Yes, that's correct. They're members of the Cowan Institute.
Barings and Principal are, LaSalle is not.
Yes.
Thank you.
I have a question. Just in the big picture, I look at these managers, they're all, the fees are like 1% or relatively equal, right? But when you go to an index fund, it could be like 13 points. And when I pulled up Vanguard, and their returns over the last 15 years are very comparable to any of these. So why do we need this manager when we can just put it in an index?
So this turns into kind of a public real estate versus private real estate discussion, and I don't know if Claire, you want to address that, or when it comes to private real estate, it's very active management, right? There's no index for private real estate, and then when you talk about public real estate, it's really correlation with equities and some other considerations.
Exactly. So that Vanguard fund that you're looking at is likely a REIT fund, which is slightly different than what we're looking at here, which is private real estate. So your REIT funds are going to be, that's essentially equity. And that's going to be more highly correlated to the equity market. Whereas with private real estate, which is what you've implemented your real estate portfolio, and you have REIT exposure within, your small cap public equity exposure. Private real estate is going to give you better diversification for at the total portfolio level, which is why we've focused your implementation of real estate with private real estate.
So I would jump in and just to simplify this whole thing, it's really about what asset is being owned. In the case of these managers we're looking at today, the actual assets that are being owned are physical buildings. In the case of something, I don't know what fund you're talking about, but I'm sure that it's a REIT fund. And what does a REIT own? REIT owns stocks. So we've got buildings that are actual buildings you can walk into versus ownership of stocks.
Real estate
which
stocks.
is real estate stocks, yeah. So that's kind of the difference, right? There's a valuation difference also in terms of if anybody, in terms of the pricing of the public market stocks, which are priced 252 times a year, right? Every trading day, those prices go up and down. On the building side, we just went through a building valuation, which we'll talk about in the budget update. That is more complicated. That is not everybody's able to have price discovery on certain buildings. So that's really the difference between the two. At one time, we did have a REIT fund. But the decision was that there's better diversification of returns. Our return streams have different characteristics when we include managers that have ownership of physical buildings. And that's a well-known phenomenon. Callan didn't come up with it. Lots of folks have shown that that's true in the financial literature.
Great. If it's okay, we can move on to the Core Plus real estate search.
But
Go
before
ahead.
you do, I want to see, I know we're in the middle of an item, but I wanted to see if there was an appetite for taking a break right now. We've been at it since, I guess 8:45. It's 10 o'clock now. Do we want to continue, or would anybody like to take a break?
I'd say keep going.
All right, let's go.
All right. I'll try to make sure we're timely here and don't keep you for another hour on this section. So when we talk about Core Plus real estate, I would first note that the universe here looks pretty different than it does for Core real estate. It's roughly just as large. There's 27 funds in the Core Plus universe relative to 25 in the Core universe, but they're not subject to the same restrictions of no more than 35% leverage and sort of the other considerations that we discussed for Core. It's a lot more. There's a lot more differentiation across these managers. Similarly, we started with 9 products that were presented to our manager search committee, and we ended up with the 3 that we're going to discuss today. Bentall Green Oak US Core Plus Fund. This is a newer fund that was launched in 2020. Pretty differentiated, and we'll go through some of those reasons why, but higher on the risk return spectrum than Core, as well as these other candidates that we're talking in the Core Plus search. Harrison Street Core Property Fund is the second candidate, and Kane Anderson Core Real Estate is the third candidate. So those are just in alphabetical order. And we'll talk about each of these funds in detail. On the next slide, again, I wanted to highlight the inception date. Bentall Green Oak launched in June of 2020. So this is the newest fund out of this bunch. Harrison Street launched in 2011, and Kane Anderson launched in 2017. So all of these are, relatively new compared to Principal, which has been around for 5 decades. But all these funds have a substantial enough track record for us to evaluate, which we've done here. From a fund size perspective, Bentall Green Oak, maybe unsurprisingly, is the smallest of these 3 because they're a new fund, but they're also growing. We've seen some meaningful growth in terms of their capital commitment activity and the traction that they've seen from the market. So we do expect that fund to be meaningfully larger as we move forward here. Harrison Street is one of the largest Core Plus funds with the $9 billion net asset value. And just for context, we talked about the Odyssey and how, an $8 or $9 billion fund in Odyssey was a mid-sized fund because the largest funds are 30 billion. In the Core Plus space, that scale has kind of shifted quite a bit. So a $9 billion fund is on the large side for Core Plus. Kane Anderson, about 3.2 billion, so kind of mid-size, right in between those two. From an entry and exit queue standpoint, really not a ton of differentiation here, aside from the fact that Harrison Street, as a much larger fund, has a larger entry queue and exit queue, but neither of those numbers on a percentage of NAV basis are concerning or really notable. About 2/4 to get your capital drawn if you were to select Harrison Street and pretty much immediately for those other two funds.
The thing that surprised me there is that Kane doesn't have an entry or an exit. Is that not abnormal? I mean, most of the reports we've looked at, they have one or the other or both. That seems weird to me.
Yeah, so their performance has been really good. So I'm not surprised to see that they don't have an exit queue. On the entry queue side, they have been raising capital. They've just been able to call it quickly because their pipeline is, they're continuing to see deals and call that capital and deploy it pretty much immediately. So not saying that will continue to be the case. That could always change in any given quarter, but that's the experience that we've had in the last several years.
Thank you.
On a leverage, looking at the leverage percentage, earlier we talked about Odyssey funds having less than 35% leverage. Most of them are in, that 25 to 30% range. You'll see that a little bit higher in Core Plus. So Harrison Street's the lowest at 25%. That's kind of where they tend to be. So leverage pretty much in line with the Odyssey. Kane Anderson, kind of similar, but slightly higher. And then Bentall Green Oak is really a true Core Plus fund. So part of where they get their alpha is slightly higher leverage. Right now it's 38%. That's kind of where we expect it to hover around 40%. So you will get a little bit higher leverage in Bentall Green Oak, which a little bit higher on the risk return spectrum, like I said. But in a market where you think values are growing, leverage could be beneficial. But of course, in down markets, leverage can hurt you as well.
And I'm recalling from my due diligence that Bentall actually has a target of 50% on their leverage, that they're not even there. So, in a rising market, leverage is good.
Until it isn't.
Yeah.
Something to be.
On the next one you might be getting to, I don't know, the number of institutional investors.
Mm-hmm.
Even relative to size, it looks like there's considerably more institutional investors, however that's defined, with Harrison. Is that a metric that is of great importance to you? And is my cowboy math off here? Is that proportional? Let's see.
Yeah, so
it looks like it's much higher.
Yeah, so
10 times higher.
Part of your question was kind of the definition of institutional investor. That's really groups.
It is,
like
yes.
Like here, institutional investors, pension funds, sovereign wealth funds,
Sure.
endowments, foundations. What's not included in that is any sort of retail or high net worth investor. Really, we don't see a lot of that adoption yet in these institutional open-end funds. They tend to be majority institutional across all of these funds, but that could change, and we're seeing some of that change in the market broadly. Kane Anderson, I don't have the numbers on me, but I do think they have a slightly higher exposure to some of those retail or high net worth individuals. It's not a majority of the fund, but it's likely slightly higher than Harrison Street, and that's just due to their kind of legacy business and where their founders have been active. But the quantity of institutional investors is important, as we talked about earlier, with respect to Barings and some of the smaller funds, that if you have a large redemption from one or two or a handful of clients, that could meaningfully change the overall position of the fund.
Well, there was a previous question about, are all of these part of the Cowan Academy? Is that what it's called?
No.
The Cowan Institute.
Kane is the only investment manager client.
Kane is the only one that isn't?
That is. Bentall and Harrison do not do that business with Cowan.
And of the previous 8, when it was 8, how many of those are of the Cowan Institute?
I could pull that up for you. So of those, sorry. I don't have that.
I can look it up while we keep going.
Okay.
For Carlisle is not. Clarion is not. Harrison Street is not.
I thought Bentall was not.
Can we repeat that into the microphone, please?
Yeah, sure.
top
I
four
have it here,
there.
actually.
We can send that.
Yeah, I'm just looking through the list alphabetical order.
Yeah, we could send that information. Now, naturally, this has no bearing on any recommendation we bring to you, and as Aaron is demonstrating, he doesn't even know. Right? And that's the way it should be, but we can follow up with that information. The number of providers that are Callan clients at this stage and then the final stage. Yeah.
I mean, I would count, I'm sharing my screen here, but I don't know that offhand myself. I do think it's irrelevant.
It's actually something that several trustees have brought attention to, though, so I think that brings it to a higher degree of relevance.
The full month, or the full quarterly report, the last several pages are an appendix that list all the different firms that Callan provides investment manager advice to the Callan customers. So you can look at that list, and it's in every quarterly report.
Okay.
Full disclosure.
Great. If we could go to, I think, 2 slides up here. So we've talked about this first one with fund size and the teams. All of these are pretty consistent. No real personnel changes to really address here. We have conviction in each of these teams. They have strong sort of succession plans in place. So no real concerns here or areas of focus. On slide 18 here, we just show, similarly, some of the characteristics at the top here. Again, not a ton of differentiation here aside from, I would say, Harrison Street focusing on, somewhat smaller investments relative to the Odyssey. And some of that has to do with their focus on, as we'll talk about, different property sectors like student housing, senior housing, medical office, life science, and self-storage. Particularly self-storage, those deal sizes are smaller, so that brings down the average investment size of $34 million relative to Kane Anderson, which is more focused on medical office buildings and medical office campuses with leased to hospital systems and health systems, for example, which tend to be larger in size. On fees, as we have a similar slide as we showed for core, that shows the fees by commitment amount or by net asset value in percentage in dollars. So we'll talk about that later. But again, no meaningful differences here and nothing to really impact our decision making on fees. So if we can move forward to the next slide.
I do want to mention, it's sort of interesting that Bentall has this 15% Canada. I know that part of, they've got a large portion of their staff that live in Canada, and that part of the company was Canadian at one point. So that's sort of a unique little quirk there.
Mm-hmm.
Yeah.
Can you explain the performance fee that it seems like Bentall only has?
Yeah, it's a great question, actually. Thanks for pointing that out. As we look across the Core Plus universe, it's not uncommon to see a performance fee. And as you move up the risk return spectrum across private real estate, you're more likely to see a performance fee. And I'm saying as you go into like value add and opportunistic funds. And it's really a way to incentivize outperformance and incentivize and compensate staff. The performance fee here of 10 over 7, so the 7% preferred return, that's what they need to generate for their LPs, for their investors, before they get a piece of it. So in other words, if they generate less than a 7%, they don't get a performance fee. And then that 10% represents the share of profits. So 90% of the profits goes to investors, 10% goes to the manager. And that's this performance fee schedule is it's very much in line with what we see and what we consider as market. So nothing to, it's not rich relative to their other competitors, but within this book, because Harrison Street and Kane don't have one, that is a meaningful differentiator.
And if I might go back to Trustee Haschek's question, I did look up the list of the 8 firms. Bentall Green Oak is not a Callan client. Carlisle is not. Clarion is not. Harrison Street is not. Hines is not. Invesco is. Kane is. PGIM is. And Principal is. Now that's at the company level. They may not necessarily be advising on the specific strategy that we're looking at, but they may be obtaining investment advice or access to the Callan database or something like that. But those are the lists of which ones were clients of Callan and which ones were not.
Hey, thank you.
Thank you. If we could just go to...
Final thing on the performance incentive fee. This fee structure is very similar to what we see in our infrastructure funds. It's the same, it's almost, I mean, it's the same exact thing, just with a different hurdle rate or a different catch up or a different performance fee. So, but it's the same exact type of fee.
It's a great point. Thanks, Robert.
Thanks, Robert.
If we go to slide 19, please. We show the property sector diversification in their own individual pie charts here rather than the bar charts next to each other, just because they're pretty differentiated. So if we start looking at Bentall Green Oak on the far left here, you'll see a pie chart that is somewhat similar to what you might expect and what we've seen from the core managers. So you've got 44% residential, 28% industrial, and then there's a kind of a smattering of these other alternative sectors, including medical office, data centers, life sciences. So pretty well diversified fund, but clearly with an emphasis on housing and industrial. I would note specifically for industrial, they kind of define it more as power. So when they talk about power, they're looking for assets specifically that have access to power in a specific market, and that kind of leads to a tenant bias that's more advanced manufacturing rather than sort of traditional distribution industrial. There's also some R&D assets and life sciences with sort of above market power. So it's kind of a nebulous thesis that can be a little bit difficult to grasp, but essentially by focusing on power, they are leasing to tenants that are sort of differentiated from the general industrial tenant base, and they're tenants that specifically need to be in these types of buildings in order to, one example of an advanced manufacturing tenant is like a medical device manufacturer, where in order to perform the things that they need to perform in those facilities, they need to have that power access, where they can't just go into any industrial building. They need to go to a specific building that has access to power. And so that's kind of the differentiated approach, the plus, if you will, in Core Plus that Bentall Green Oak is trying to implement here. And they've been pretty successful. The market has kind of received that well, and they've seen some pretty strong performance, as we'll talk about later, that's been driven by income growth. So it's not that their outperformance has been driven by appraisers marking up their assets more than others. It's the fact that they can charge more for rent at these buildings because they have more pricing power over these tenants, these industrial tenants.
I have a question.
Sure.
The Bentall Green, it's a little confusing with these charts that the color appears to be being used but not for the same category.
It's different categories.
So
Yeah.
does the residential on the Bentall Green include the senior housing, or is it only residential? Like, is it strictly residential, single family?
It's strictly multifamily residential right now. It does not include senior housing. So yeah, the yellow on this chart does not include the yellow on the other chart.
Green industrial versus self-storage is also...
Yeah, apologies for that. Yeah, we should make the colors consistent across these bar charts. But thanks for the question. For these specific charts, I would think of them as distinct. So the yellow on the BGO pie chart is only residential. It's something different for the others. Apologies for that.
One thing that I note on BGO residential, 9 of the 10 largest assets in BGO are those apartment complexes. And I want to thank Trustee Cubison for pointing that out, because that is definitely something that I look at when I produce a report for you, having the same sectors be the same color across the managers.
If I could ask a question on, I noticed that Kane has a significant investment in medical office, 70%, And if you look at the next slide, they also have a very large investment in this geographical south. So they're almost specializing in southern medical offices. And I'm wondering if there's any concern that maybe that's a little too specialized.
It's a great question, and I think it's a great point. When we talk about Harrison Street and Kane, and I want to address your question specifically, but I do think it's important to kind of differentiate these two. Both of these groups they're kind of hard to distinguish. People often lump them together because they're both alternative sector specialists. They both offer a core fund, open-end, and they also offer a flagship kind of diversified non-core opportunistic fund. So the key ways that I would differentiate these two groups, I would say Harrison Street, this is a much prettier pie chart. It's more diversified.
Very symmetrical.
Exactly.
It's like a beach ball.
Exactly. Yes. And I think that's intentional. I think they have a top-down view of saying, look, we're going to...
Yeah. I had written in my notes to comment on that it does look like a deliberate asset allocation that they're following.
Yes.
That they're intentionally, which is either good or bad. I don't know.
Yeah. And
if they're beholden to their asset allocation, they might not be able to take advantage of rapid changes.
Yeah, that's an excellent point. And I think that's the right distinction to draw here, is that Harrison Street has a more top-down view where they start by saying, okay, let's create a pie chart that's well diversified, and then we're going to go find the deals in those specific asset classes or in those sectors. Kane, on the other hand, is more bottom-up driven. They look at the market and say, where are their opportunities? Where is their relative value? And for a while, when they launched the fund in 2017, what they saw was opportunities in medical office. So they went and bought medical office because they thought that was the best thing to buy at that time. They stayed away from student housing because pricing was expensive. They stayed away from self-storage for the same reasons. In other sectors, due to supply and demand. So they're very focused on the fundamentals on the ground. And so it's really a more bottom-up driven portfolio where today you end up with a very concentrated portfolio in medical office. But if they were here, they would tell you all about how convicted they are in these specific assets, and they think they're buying the best assets on a relative value basis. What I would say is that has hurt them in searches. I think maybe if they were more diversified, there would be potentially more client interest in a fund that's maybe not 70% medical office. And in our conversations with them, I think that's something that they've acknowledged, but they've kind of stuck to their guns and said, this is their investment approach. What we've seen change recently is that they're now seeing more opportunities to acquire student housing, and they've begun to do that, including in this fund. It's not included in this pie chart yet, but they bought some student housing. They're buying some self-storage, so this pie chart will be meaningfully more diversified over time. That medical office will come down from 70%. I don't have great guidance on whether that's going to be 50 or 40 or 30%, but we will see more diversification on this pie chart, which is something I think to look forward to there. But it's a great question, and that's kind of how I would differentiate these two groups.
I'd jump in and say, medical office has been very strong, as evidenced by some of their performance. So I wouldn't have any concerns about the sector. In the South, there's been broad migration from within the U.S. and outside the U.S. to the South. The trope is that all retirees move down to Florida. I don't know the specifics of the Kane locations of their medical office, but if you were to ask me the South and medical office, I'm thinking, okay, this sounds pretty good to me. The South has been sort of popping off in terms of migration. Student housing is another very interesting sector that, while it can be expensive, there's certainly a lot of demand. It's one of those kind of non-economic growth sectors. It's just sort of consistent all the time. There's always students churning in and out. Some of those payments are made by the universities, so there's not really this sort of potential contracting GDP impact that you might see somewhere like industrial, for instance. So it's a very interesting sector.
Going to 20, be interesting to hear from them why they are in the different regions they're in. across the board from everybody. I mean, excuse me, Harrison's heavy in the east and west, and then the other end, Kane's mostly Midwest and South, which to me is underperforming areas except for what you're talking about. So, do you have a sense of why they end up in these regions?
Yeah, I think a lot of it has to do with their specific property sector allocations. So earlier we talked about office buildings. If you're going to own office, you want to be in gateway markets where there's a lot of office using employment. If you're buying student housing, you're not going to be in those markets. You're going to be in Tuscaloosa, Alabama, where you probably wouldn't buy anything else except for student housing. Medical office, as we talked about earlier, you want to be concentrated near the health systems. And those sometimes are not in, major Western markets or in the Northeast. Like, they do certainly have those there, but there are areas in the South where you have a dominant health system where you want to be located with them. Some of the medical office exposure, so I just filtered kind of the largest medical office assets that Kane owns. Chicago, Atlanta, Buffalo, New York, which is obviously east, Daytona, Florida, Dallas, Atlanta, Omaha, Nebraska, Jefferson City, Missouri. So you do get some sort of smaller market exposure, which, maybe there's less liquidity there, but if you've got a dominant health system with a long, high credit, long-term lease, you feel pretty good about that. But I guess the point being, you're kind of drawn to these specific markets based on your property sector allocation. Bentall Green Oak, on the other hand, their regional diversification looks pretty similar to that of Odyssey. We don't have that overlaid here. Oh, actually, we do. In the tan charts on the right, it looks much more similar to the Odyssey index than the other Harrison Street and Kane. There are no other questions on diversification. We can move just one page forward, please, to performance. So BGO, as I mentioned, track record starts in 2020, so we don't have quite the long-term track record that we do for Harrison Street and to a lesser extent Kane. But Bentall Green Oak has performed really well since inception. I talked about it earlier, but a lot of that was driven not by appreciation, but really by income. Their net operating income growth has outperformed significantly due to their pricing power and their ability to drive rental rate growth across their assets, not only in industrial and power, but also in healthcare. They do have some medical office as well, and then in residential, which is 44% of the portfolio. Interestingly, when we look at Harrison Street and Kane, well, I guess for all of these funds, they outperform the Odyssey, which is what you would expect out of a Core Plus fund, right? So the Odyssey is the benchmark, but in general, because they're taking higher risk, you expect a risk premium over that. When we look at Harrison Street and Kane, both have outperformed the Odyssey. I'll get to the trailing returns on the top, which is really the punchline. But first, if we look at the calendar year returns, you'll see in 2021, the Odyssey generated a 21% return. So that's core real estate, 21% return. And Harrison Street and Kane didn't really see that huge pop. In alternative sectors, it's a little bit more steady Eddie. You think about medical office as a significant part of the portfolio. You're not, these are long-term leases, 7 to 10 years. So, you're not necessarily seeing the same pop as you do in medical office as you do in some of the more traditional sectors. But it's also a lot more resilient. If we fast forward to 2023, when we saw real devaluation in the Odyssey index, the alternative sectors were slightly more insulated from that. So instead of a minus 13 or 12.7% return, Harrison Street had a minus 5.8 and Kane had a minus 2.6. So a little bit more resilience in sort of down markets.
And Aaron, just for trustees, I would point out the rolling period here down at the bottom of the page, right? That exactly what Aaron's talking about. We can see that in the 3/31/24 period here.
Yes. And then just going back up to the top chart here, which is the trailing returns, you'll see Harrison Street and Kane both outperform the Odyssey, which is what you would expect, as I mentioned. But Kane has performed meaningfully better. And I think some of that is their asset selection. And we talked about kind of them being very selective and bottom-up approach, finding the right deals, the best relative value. That led them away from, we talked about student housing and self-storage. And if they were to go buy self-storage beta or student housing beta, just for the sake of having that in their portfolio. We likely would have seen a little bit of dilution from these returns as those asset classes got marked down. So they kind of actively avoided that. Harrison Street, right, like they perform well. This portfolio has done what you would expect it to do. They have exposure to all these different sectors that have been more resilient than the traditional property sectors. So more diversification. They've had some of that, negative impact of performance from, certain sectors that they've had allocations to, but they've been much more resilient than a traditional Odyssey fund. So the point being, in each of these three funds, if you're thinking about a diversifier to your existing portfolio of 2 Odyssey funds, Bentall Green Oak will get you some alpha through their differentiated approach. Harrison Street will give you differentiation and likely insulation and more resilience in down markets. And Kane Anderson will try to drive alpha through their asset selection. Sure.
I have one other comment, I guess a question for you. I guess I probably should have mentioned this earlier, or said something earlier, but the Odyssey benchmark here is value weighted, right? VW net?
Yeah, it is value weighted.
It's value
yes.
weighted as opposed to equal weighted, which is what we actually use for our return comparisons. Can you mention the difference? I know the difference is slight, but maybe you could mention that for trustees.
Yeah, so as we talked about, the Odyssey Index is comprised of 25 funds. There are some that are 30 billion, like I said, and some that are 1.5 billion. And so when you equal weight them, each of those 25 funds is has the same contribution to the total return when you build a composite. In the value weight version, the larger funds have a more significant impact on the total return. So lately, we this changes over time, but lately some of the larger funds have underperformed. So the equal weight benchmark has performed better than the value weight benchmark. So there are some slight differences over time depending on if the larger funds outperform or the smaller funds outperform.
So the way I think of it is the equal weight helps you decide if you picked a good fund, because you could have picked any one of those 30 funds, right? So the equal weight is saying, did I pick a good one? The value weight is a better measure of what the market is, right? So all of the value of all the real estate out there. So it's a little bit more like, hey, what's the S&P 500 return? All the stocks out there, right? As opposed to, what is the return of the average stock or the average investment I could have actually been in the equal weight.
Great. I think I've got one last slide here on Core Plus, and then we can address any additional questions here. Similar to what you saw before, managers on the left, NAV, hypothetical net asset value across the top columns here. Again, pretty similar fee load. I would note that Harrison Street and Kane are really identical, whereas Bentall Green Oak has a lower management fee, but they do have that performance fee as we talked about earlier. So something to consider in an outperforming market. If Bentall Green Oak meets that hurdle, you will potentially be paying them a performance fee, but the asset management fee at a headline level is going to be lower than what you'd pay for Harrison Street and Kane. And then on the bottom here, we show just the mapping, just to show, as we talked about and hopefully illustrated, on the risk return spectrum, Harrison Street and Kane are sort of on the lower end of Core Plus, kind of straddling Core and Core Plus. The business plans that they implement at the asset level tend to be core. The leverage tends to be core. The Core Plus is really in the adoption of these alternative sectors that they're exclusively focused on. Bentall Green Oak, I would put clearly in that Core Plus category based on the leverage like we talked about, some of the business plans that take more leasing risk and things like that. So that's how we put them on this risk return spectrum. And then fund size, as we talked about, Harrison Street, quite large for a Core Plus fund. Kane Anderson, kind of mid-size, and BGO, smaller but growing, just as it's newer. So with that, I'm happy to address any questions about any of the Core Plus candidates of the search here.
I'd ask a question of trustees. On the Core Plus side, there's some very interesting, sector exposures there. Not geographic, but just in terms of the sectors. My question to trustees is, what stands out to you there? what makes you feel comfortable when you look at that pie chart? What makes you feel uncomfortable? If anything, considering they're all outstanding.
Well,
I like the beach ball pie chart. Diversification is nice for safety. On the other hand, it saddles you with not being able to do opportunistic things, where the concentration of one thing, the benefit of that is that you know what you're looking for. You can be an expert in that particular thing. Don't have to worry about student housing or whatever. So, yeah, for the aggressive investor, I think the concentration is nice because you've got, I think, a concentration of effort in one particular asset. You can really know what you're doing there. But then for safety's sake, I like the beach ball.
I guess I would have some questions about maybe the macroeconomic situations surrounding medical and student. I know that medical might be relying on a lot of federal money, and I think there's been a lot of efforts to cut that. Same thing actually with senior housing, but student housing, I think you have an issue where people are maybe leaning a little bit more towards educating themselves at home in front of their computer, watching YouTube videos. And so I would wonder if those are great investments right now, macroeconomically speaking. And that's what I would think about this. And I mean, I do like the beach ball, but I mean, not for the sake of it being the beach ball. And the other thing is that, when you look at BGO here, it has the data centers issues. That's almost a different sector to me. And that's a specialty sector. I don't know that that it is. I certainly don't mind that as an investment. I think it's a good investment, but it's kind of odd that I see it here. Those were my thoughts on it.
That's a good point on data centers. BGO has some expertise in data centers and some track record there, so they're not totally new to the sector. I should also add that Harrison Street, while they don't have data center investments currently, they did recently approve in their fund docs the ability to invest in data centers, and they do have a dedicated team focused on sourcing and managing those deals. So in both Harrison Street and BGO, you would get some exposure to data centers. They do tend to be, more core type data centers. I would think like hyperscaler facilities. If you've heard that term, it's really the 5 major users of data centers being kind of the cloud and large tech companies leasing those spaces, as opposed to sort of the smaller data center facilities that might have shorter lease term or credit that's not quite as good. And they also stay away from real development, which can be higher risk.
Yeah, I guess I would wonder why. I mean, I almost consider data centers to be closer to the infrastructure type of investment class. I mean, they're such specialized. You don't just run down and get a permit and have your brother build a data center. Not that you do that with other things, but it's such a specialized set of equipment, power requirements, facilities, locations. It's very specialized, I guess, is my point.
Yeah, that's a great point.
Not saying that's good or bad.
Yeah. So,
You want to comment about the data center building versus the operation of the data center,
Well,
which is
that's
on
where
the
I-
infrastructure
yeah.
side? I don't know.
I was going to bring us back to the top line question at hand, but don't want to cut that off if the discussion's.
Oh, I'm done with it.
Okay, all right.
Personally.
So ultimately, the question on the table for today is which managers do you want to interview? So from my perspective, there's still 2 questions. What do we want the real estate portfolio to look like? Include Core Plus or not? And question 2 would be, who do we implement with? What managers? So I would say to the first question, it sounds to me like the board is still interested in potentially pursuing an allocation to Core Plus. That decision doesn't have to be finalized today. But I would say that's question 1. If yes, Are you willing to interview all 3 managers, or is there one that clearly the board, is not interested in? And then question 2 would be the same for core. Are you willing to interview all 3 managers for the core search, including Bearings, or is there a subset that you'd like to interview at a future meeting?
I'll give the opinion of talking to LaSalle on principle, and then of Harrison and BGO.
Is that a motion?
That's just
That's-
opinion.
I don't think we're quite ready for that yet.
Yeah.
I think at this point, it actually would just be direction from the board. It wouldn't be, need a formal motion. It would be direction on which managers to invite in.
Because I could agree with that.
So you left off Bearings on the first, on the
Yes.
core, and who'd you leave off on the?
Kane.
Kane, okay.
But I look at the performance on the plus, and I just kind of scratch my head a bit on the performance. But
What's your rationale behind cutting Kane out of the equation?
there's going to be a lot where
Is it
the sectors that have gone in for medical, the federal funding issue, in the South and the Midwest, those are underserved areas in one sense. And how long they can hold out there, how long the docs can hold out, the hospitals can hold out.
Right. I guess I would lean towards giving them an opportunity to explain their position. But at the same time, not leaning too hard on that. If their intention is to make their 70%, maybe start to diversify within themselves here, both geographically and in facilities.
Sounds like they have for what Harris said. With
Like they've already,
student
maybe
housing
this
and-
is,
yeah.
they've already made that decision to do
It's just
that.
not reflective on the chart yet. Student
Yes.
housing was one, and you said another.
Self-storage, they're also looking to allocate to.
So they are considering that.
They have documented and voiced an intention to reduce medical office and diversify further. But what we don't have is like a long-term target of like, this will be 40% in 3, like we don't have that.
Well, I have that.
Oh.
And their long-term target, Kane, 50% medical office, 20% student housing, 20% senior housing, 10% self-storage. It's probably going to take them a while to get self-storage. Self-storage is hot. It's been hot. It's expensive. It's hard to find good locations.
I think I don't think that adds up to 100. Like we need
Yeah,
another
that's
10% out of it.
No, that's 50
Okay,
medical,
50,
20 student, 20 senior,
Oh, 20 and senior. Okay, so
10%
senior.
self-storage.
Okay.
So that's the intention. The other thing I would say about Kane in terms of the medical, and if we brought him here, we could certainly ask him to talk about this, but they have a specific medical office platform that they're using. So the fact that they're so concentrated today at that 70%, it sort of makes sense. That's how they were built. They're good at that. They have a whole platform research team that's working on that. So that sort of explains a little bit of that concentration. But they do have intentions to move away from that a little bit, right? Knock it down 20%.
I think it's half a dozen one, 6 in the other, but.
Well, I think that's interesting information, but
I have no issue not to talk to them. I'm more of Alex's belief to say, I totally agree on core, Richard, that Bearings wouldn't have made the original cut on what they would have cut, so, and all of us have been scratching our head about Bearings for a long time. So if they don't get invited to the table, I have no heartburn over that. On the Core Plus, which still isn't deciding we're gonna go into Core Plus, but at least give them an opportunity to do a presentation to us. I think the positives of medical offices were the returns they were getting and then the long-term leases. So it's more of a stable investment strategy for them, and it's proven so, but they are moving away from it. So I go either way. I'm more of the Alex blend here, that I have no issue with the 2 non-Bearings on core. And if we interviewed all 3 on Core Plus, I would be fine with that too.
Sure.
Me too.
And I guess I would ask Robert your opinion on that, not bringing Bearings in for core.
Well,
And not
so
allowing them to
let me
compete.
step back and say I think adding a core plus for just the manager diversification alone, Callan would agree that's a good choice.
So that's on the first
Absolutely.
question of what our
Absolutely.
asset allocation looks like within infrastructure and within real
Yeah.
estate.
And so when I think about the core strategy, I think about, and one of the things that I looked at are the sector allocations given these new managers. So if we swap out Bearings and now we go with LaSalle, what do we look like with one of these core plus funds? If we swap out Bearings and we go with Principal, what do we look with these three funds? And the question that I think about is how similar or not similar to the Odyssey do we want to be? And so there's varying. Every trustee probably feels a little different about that. But the point of the core plus is to differentiate a little bit outside of those core sectors. And to be fair, and we didn't talk about this because we didn't even really get into the sector exposures of REEF, but REEF has some of these alternative sectors within their residential. So, we may report, 30% residential from REEF, but if you actually dig into what that 30% is, it includes student housing. And, a memo or two ago, I talked about the student housing development that REEF has in the pipeline right now today. Of course, it's going to take 2 years for all those projects to be done. We're not going to see the benefits of that for a while. But all that's to say is the next question of the core replacement is how differentiated from the Odyssey are we comfortable being? I think we're probably at this point pretty comfortable being underweight on the traditional office sector, right? I think we're all sort of in agreement on that being underweight there is a good thing. My opinion, and I don't know what Aaron's opinion would be, but on the other sector, probably being overweight and potentially getting ahead of some of those trends would be good for us in 5 years. So, I have a tendency to want to lean towards that. So how can we increase our alternative other exposure while at the same time potentially keeping an underweight to traditional office?
Well, the core plus has outperformed the core, I think, generally.
We would
We've got
expect
front
that.
of it.
Yeah.
So, over 7 years and 5 years, it looks like.
Yeah.
I'll go back to not having variance in here. That would just be, to me, like, explain why you failed to us and why you're doing better. I mean, that's not I'm not interested in that.
They were overexposed to the office market.
Yeah.
They had levered up their office portfolio, and as a result of having to write those down to reposition the fund, which I think they've successfully done, they had to take those large losses. Now everybody took a little bit of a loss, but those specific assets were, highly levered at the wrong time. It was sort of a timing issue and an asset selection issue. Is it luck? Was it bad luck? I don't know.
Yeah, I mean, they look good in one quarter and they look good in 2024 compared to the others.
The thing that I have been thinking about is this notion of making inferential errors on performance. And what we have now with Bearings is a currently overperforming fund as a result of this long-term, 3-year period where there's been massive underperformance as a result of these write-downs.
I have an alternative, Chair. So, in my time on this board, we've been very deliberate and intentional and systemic in what we do. We aren't brash. We don't make knee-jerk reactions. We, from everybody that I've heard talk, have decided we want a new core. everybody's agreed to that because we're not going to interview Bearings, it sounds like. We're keeping Reef, which we already decided prior to this meeting. So I think to be deliberate, intentional, because we've already decided we're going to get a new core, we could interview the core first to decide who that's going to be, and then introduce and invite Core Plus managers to come in and explain to us how they would be complementary to Reef and the new core manager. And then decide at the end of all that if we're going to go Core Plus as well.
So if we make a decision, let's say we selected a new core based on that scenario, we would then be waiting at least a meeting, maybe two, before we could even begin to execute because we'd not have a final decision on actually moving money. And we know there's a large exit queue that might take us a while anyway. So whatever we do is going to take a while.
Yeah, I would agree with that. And I would separate the interviews into two meetings regardless, just because it's a lot to sit through.
Oh, yeah. No, we wouldn't do all 5 in one meeting. I mean, I don't think.
And then it'll
legally
take
has the
time to
appetite
implement
for
where do you
that.
get the capital from, how do you put it to work.
And I mean, even if we went through, it's not like, even if we went through this exercise, that does not necessarily mean that we would, as I'm seeing it, we have not yet fired Bearings, right? I mean, we're not going to interview them again, but we still have we have $32 million with them, I believe. Yeah. And it's going to stay there for a while, no matter what we do. So I like that in general, bringing in LaSalle and principal initially. I don't know how long that would take to line up. Is that a September thing?
They're all aware. We can
Okay.
we can bring them in the next 2 months.
Yeah.
They'll be
Yeah, I imagine that they would not put us on the back burner if we wanted to talk to them.
They're all aware.
So based on that, do we have a consensus of direction at this point of bringing in LaSalle and principal?
Can we get, just for staff, can we get clarification on, I guess, the order? I'm sort of confused about the proposal that Trustee Cromer was making. Can we clarify that?
We can, but it wouldn't, I mean, we could change our mind on it based on how he phrased it. We bring in LaSalle and principal. If we like them, that would be probably where we would be then moving our core to. Then we can decide, then we can bring in the other 3, whose names I can't remember off the top of my head.
The Core Plus.
The Core Plus candidates. And I'm thinking that we're leaning towards all 3. And decide if we want to change how we break our allocation within our allocation on real estate. And decide then if we like them, or if we're going to put the whole lump in with our new core manager, or we're going to split that with our new core plus our Core Plus, which would be basically interviewing everybody to decide if we're going to end up with option 2 or option 3 on page 5. Am I making any sense?
Well, I guess in part yes, but my clarification was I thought Trustee Cromer said bring in Core Plus first.
Core first.
No, okay, that's what was confusing.
Core first.
Core first, Core Plus second.
I said we've decided
Okay, yeah.
essentially we're going to a new core manager, so let's figure out who that is, because that's, to me, a very important part of this, to decide if we're going to go 2 or 3 on the options. I'm still not decided on Core Plus, but I think a big portion of deciding on Core Plus is how they complement Reef and the new core manager, because that is one of the most important slides I look at when they do that study of those companies, is how are they complementary to the other managers we decide in or are currently invested in.
And you've already looked
So I'm going to retract my statement about Bearings. And I don't, can we get 2 more quarters of information on Bearings' performance? We can get at least one pretty quickly, can't we?
You mean for how they performed in the second quarter?
Yeah.
Yeah, I can pull that up.
And then, I don't know how it might look for the third, because they, we did write them down. And now they're, climbing out of this hole.
Yeah, we're to inform everybody over
I think
the
they wrote
next.
themselves the wrong time.
Yeah, they did a lot to restructure
Right,
and
and-
reposition
and-
their portfolio, and I
And
think
just
you've seen that in the short term.
remembering that too, is that 21.36 with the write-down they had, and 23 is ugly as a number, but with an explanation and a new direction, it might, I mean, it is for them to do something, that's for sure.
You know, I think there's general debate about the Odyssey benchmark also. You know, think about this. If you don't have to reposition your portfolio, you're maybe less concerned about writing assets down, right? The reason why you want to write them down is so that you can transact on them. If you're not needing to transact, and it's just a leasing issue, you know, maybe there's a less tendency to write those down. You know, it's also so region and sector specific, market specific, you know. So it's hard to generalize on some of these.
Yeah, just on those data points for performance. For the second quarter 2025, Barings generated a 1.3% gross return, 1.1% net return, and relative to Odyssey, they outperformed by about 20 basis points. That's for the second quarter. We're still in the third quarter here, so we don't have that data yet.
And then maybe what LaSalle did, he did that in
Yeah. So once again, Odyssey was about 1%. LaSalle outperformed. They generated a 1.66% gross, and Odyssey was so about 60 basis points of
Okay,
outperformance.
so that was much higher than Barings.
That was gross.
That was gross, yeah. And on a net basis, LaSalle generated a 1.49% net, and Odyssey was 80 basis points net. So similar, about 70 basis points of outperformance.
I'm sorry, which one, who outperformed?
LaSalle outperformed.
LaSalle.
Okay,
Yeah,
LaSalle
so
outperformed
actually
Barings, and
beat
Barings
Barings.
outperformed Principal in
Right.
the
Uh,
Q2 of year 25.
It looks
Calendar
like
25.
LaSalle's diversification was the key there. What they got into was the right stuff.
And Principal also outperformed relative to the Odyssey. They actually outperformed pretty significantly, more so than LaSalle. So Principal generated a 2.1% gross return, so about 100 basis points greater than Odyssey. There's really a lot of noise quarter to quarter. Like Principal, I think, underperformed the quarter before. If we go back to that search book, I think there was some, so there's a lot of noise quarter to quarter. I wouldn't put too much stock into, outperform one quarter, underperform the other quarter. But over long periods of time, that's what we're trying to show in the book.
But if Barings was over 3 quarters for 20. Add this one quarter that's on the chart, and the other one, I guess it's 2, that's about average 1.3. Trying to get a better sense than just a quarter.
So I think Barings, I believe 5 out of the last 6 quarters, they've outperformed Odyssey. So we have seen a really positive trend from them. Again, we looked at the 2023 numbers. They took a lot of pain in those office valuations specifically, and also elsewhere in the portfolio. Moved on from those office assets and are now seeing kind of the benefit of that. So we have seen some recent outperformance from them. I think it's certainly something that we should consider, that the performance has rebounded, but also wouldn't want to overstate that, right? Like you're going to be invested in this fund. Let's say you put in a redemption request, hypothetically, you're still in that fund for 2 to 5 or 2 to 6 quarters, right? Hopefully you continue to see outperformance, right? The question is more, do we have conviction in this manager and this organization to continue to drive long-term performance? Are they folks that are staying ahead of the curve and are going to make investment decisions that will benefit the long-term performance of the fund? And then also on the size question, which we talked about earlier, is there enough diversification in this fund by asset, by investor type? So those are kind of the questions that I'd want to focus on.
So, the diversification is still very different from Barings too. So not very different, but it still is leaning towards industrial and retail. And so, that's a different decision if that also means we want to maybe not be as involved in those areas as well. I don't know if there's a trend for them, or if they're moving around, or if that's still staying fairly stable.
for Bearings specifically. Yeah, Bearings has expressed some desire to expand into some of these alternative sectors. Historically, they've really invested in self-storage in that other category. And they recently made an acquisition of Artemis Real Estate Partners, which is another real estate manager that's done very well, and they have some expertise in alternative sectors. So I think some of that expertise may bleed over into the Bearings Core Property Fund. But in general, I would expect their industrial and residential to, remain the largest components of this fund, de-emphasizing office and retail to a certain extent.
So I guess that brings us back to the original question. What do we recommend for interviews? It sounds like we do want interviews. And I think what we're down to is, does the preponderance or is it the general consensus? Seems like we all want Principal and LaSalle. We want to go with the Core Plus, or the Core first, and then follow that up with Core Plus, based on Trustee Cromer's suggestion. And the only question is whether we bring Bearings in to actually try to fight for their business, or whether we would just, we know that they're part of our equation already. We don't need to talk to them. We just stick with interviewing Principal and LaSalle.
If you brought Bearings in, it would be an opportunity for them to sort of explain how they're positioning their portfolio now going forward on where we expect to see maybe growth in certain types of markets. Obviously, office has been depressed since COVID happened. How these any of these managers fit in with our other existing core manager, the Reef product, because they sort of have a high allocation to industrials, which might become more challenged. Industrials had been an outperforming region or segment of the real estate market for several years up through maybe 2022, 23. And now it's looking like there's not quite as much demand in the industrial sector as there had been the past few years. So how they complement each other is a good question. I think that's what Trustee Cromer was bringing up, is looking at how any of the managers will complement each other in the portfolio.
So I'd like to say one final thing, at least in terms of those new managers. On the LaSalle side, going with LaSalle is going to give us a very strong underweight on those office sector assets. But they're also going to give us a strong overweight on the industrial side, right? So there's sort of a trade-off between both of those sectors. On the Principal side, our underweight to office would be about half of what we would expect with LaSalle. And depending on the new manager, we're still going to be underweight this retail sector, which has been very strong. There's no construction. There's only so many retail building, office, shopping center areas that are available. And so, it's really about how much office do we want to maintain or not, in my view, and how much underweight on the industrial. I'm a little nervous of the bull run on industrial, and the bullishness in general on the multifamily apartment. Right, that's the other big differentiator here. If we want to be overweight in the multifamily, either one of these two managers with Reef and a potential new core are going to satisfy that. So I guess I'm not sure that I'm even really being helpful now that I'm listening to this, right? I hear a lot of options coming out of my mouth, and I'm not really, providing too much direction on that.
Would you be concerned about the amount allocated to industrials if we have Reef and LaSalle?
I would be, and I don't know if that's...
Is that a significant concern to you, the allocation to industrials?
Well, if you look at Bearings, it's higher industrial, and it's the same level as LaSalle in office.
I would say as the kind of in the intro or the outro of the manager interview discussion at that meeting, we can put together, what the combinations of each of these managers with REEF looks like.
Yeah, and also if there's indecision about whether or not you want to interview Bearings, just bring them in,
Yeah.
right? It keeps all your options open.
Yeah.
And we can make that decision. You don't have to pick them right now. And if that's where you're stuck in making a decision, bring them in, interview 3. The likelihood is they're not going to be retained, right? But let them bring in, and they've been a partner of yours for a long time that can compete for the business.
So we can bring people in for the September meeting. I'm sorry,
Okay.
we can bring people in for the September meeting. If you want us to bring in all 3 core, we can certainly do so.
Let's just, I guess we're down to do we bring Bearings in or not? And how many people would like to see us? How many trustees would like to see us bring Bearings in? 1, 2,
3.
3. And I would lean towards bringing them in based on what Greg said there. So let's have the direction. I hate to be a minority on this one, but let's just direct that they come in.
Okay, because right now it would be split 4-4.
4-4.
Because we don't have Trustee Kapnis here today.
But if Trustee Kapnis is listening in, she could pipe in, and this is not a vote, so she would be able to offer her opinion on it.
I think you just go with, it's only 40 minutes of your life.
Yeah.
Yeah, just bring them in.
Wise.
Okay, bring them in.
Yeah.
More is better. Under the more is better philosophy.
And we can work on scheduling for October the 3 core plus managers if it's the board's desire to interview all 3 of them, or was it just 2 of them?
All 3.
I believe it was all 3. Interview everybody.
Okie dokie.
Tour in September.
What
What do you guys want?
What's that?
Core plus in October.
And would we, in a September meeting, we would just take the information and hold, or we would make a decision?
I think it could go either way, but generally, when you do the manager interviews, you're making a decision, and we would likely want to know the outcome of your core allocation to further the discussion of the core plus managers.
So then I would look to staff and Callan to take this discussion you heard today and kind of line up stats, like the columns of what Reef has, and see
How they compare and complement each other.
How in combination they all work.
With how Reef would be if we stuck with Bearings or went with Principal or with LaSalle, each one of those
So
lined up.
Core Plus looks like it performs a little better than Core, at least the people we talked to. So to set it aside is, we don't want to do that right away.
I just want to mention that at the September meeting, you can make a preliminary decision. You don't have to make a final decision. If you think the Core Plus, you want to wait for that, that's the board's call. I mean, I don't know if Callan has feelings on that one way or the other.
And I think Claire had offered to bring back the information that you had just requested, Trustee Shoemaker, so I don't think that would be a problem to have that at the September meeting.
Yep. Tee that up.
Okay, it sounds like we have item 2 completed. Do we have everything we need? Judy, are you clear on everything there? Okay. How about a 10-minute break? Okay, sounds like a 10-minute break. We'll come back here at 11:25. Let's make it a little bit more than 10, 11:25. Judy.
Just trying to.
Budget is
Just-
there are muffins.
I just got an email back from
In the
Some
coffee
muffins.
break room.
I'm just confirming that this concept is information from job care records.
I knew you were wrong, but I didn't know how much.
I knew this was going to be a 10-minute item. In fact, I thought it was going to take over for job care. on
Care's
the
under
quarterly stuff.
Adventist Health.
But I want to say this.
It's part of
I would like
Adventist
to
Health.
see
It's always
this
been
more
under the hospital.
into
All right, so ready? Okay, we're back.
Okay, we are back. And we will move on to item 3, fiscal year 24-25 preliminary budget update. Robert Revelis, Retirement Financial Investment Officer.
Trustees, you have the preliminary quarterly budget update for the final quarter of fiscal year 25. Almost all of the expenses are reflected in the report. We expect a few very minor changes that will transpire by the end of next month. So we'll probably bring a very short future update. It's typically one page that goes over the differences between our final year end after the audit versus this preliminary budget report. But I do expect them to change very little, a few $1,000s at most. So I'd be happy to answer any questions you might have. I went into a little more detail because it's the final quarter, but I'd be more than happy to answer any questions.
That's okay. You can.
Are there any questions on this item? Seeing none. Thank you, Robert. I guess you know what? We didn't ask for public comment previously either.
You should. Go ahead and ask.
Can we retro ask for public comment on investment matters?
Sure. I was looking at the participants and I didn't
That's
see.
him.
I actually left,
Oh,
so I'm not
Yeah.
reflected there anymore.
Okay, there are none.
I think it's
They
Catherine.
have
might be
to raise their hand if they are interested in
Okay, so there are.
saying, but it doesn't look
Yeah.
like Catherine is listening in.
Hi, Catherine.
Okay, so and I assume no public comment is waiting on item 3 either.
No, there is no public comment.
That will move us to item 4, option 4, allowance under Government Code Section 31764 for Douglas Gherkin. Doris Winchler, Executive Director.
Thank you, Chair Land. This item is a motion to approve the request for an optional settlement for allowance for Mr. Gherkin. He has requested a non-spouse beneficiary of his son to receive a 60% continuance. Because we don't do very many of these, the board had asked them to be presented as a separate budget or a separate agenda item. So we're looking at a motion for that. As per our policy and required by law, there is no additional cost to the retirement system to provide this optional allowance to the member. And in the future, we can either continue to provide those as a separate board item or just put them as part of the consent.
So is he asking for his wife to have a certain portion and
No.
then his son?
There's one beneficiary, his son, for a 60% continuance.
And then if this were to be split between a wife and a child, how would that go?
All of the option 4 allowances are calculated by our actuary to be the same present value cost as the allowance to the member themselves, regardless of what the continuance percentage to the specific beneficiaries is.
Yeah, hey, actuarial.
Yeah.
So I guess I'll open it up for board discussion. Does anybody want to discuss anything on this? I actually...
I'll move staff recommendation.
Before we get there,
I'll retract that motion.
do we want to continue to have these come on to the agenda when it sounds like the work has been done? We really are not going to be in a position to not approve these. Yes?
Yeah, I think that if it's cost neutral and we aren't in a position to, we might as well just do it on the consent calendar.
Theoretically, I guess the board could decide not to offer the option 4 in a specific circumstance. I can't identify one of those at this particular point. It would still be part of an item on the consent agenda for the board's consideration that could always be pulled for separate discussion if necessary.
So based on that, I mean, I would just throw a recommendation that the next time this whatever policy covers this comes up, we did.
It was board direction last time to
Oh,
bring
was
them
it?
as a separate agenda item.
If I can offer some
Context.
I think there was a previous trustee on here that had a very hard time understanding how this is cost neutral to the plan, and that's why that direction was given, but I agree with the direction being given now.
Okay.
Great, thank you.
In that case,
Move staff recommendation.
we have a motion.
Second.
We have a second. Roll call, please.
Mr. Kelly,
Aye.
Mr. Haschak,
Aye.
Mr. Cromer,
Aye?
Mr. Shoemaker,
Aye.
Ms. Harris. Aye. Ms. Cubison. Aye. Mr. Land.
Aye.
Approved. Thanks.
My microphone off.
We can hear you.
Hopefully there's enough mics.
Okay, item 5, trustee succession plan. Dora Frenchler, executive director.
Thank you, Chair Land. For some of you who weren't here during the strategic planning process, one of those goals was establishment of succession planning, both for staff and for trustees to the extent possible. We already have an adopted policy regarding succession planning for staff positions. This proposed policy is to fulfill the strategic goal to address a a succession plan for trustees as they sit on the board. So there is a draft policy along with some additional information attached to the proposed policy. I'm happy to answer any questions you may have.
Yes, trustee Harris.
Thank you. Is this where the 45 days is, correct or not?
Correct. Item 5 on page 3 of the PDF states that new trustees will attend the board's new trustee orientation within 45 days of their election or appointment. That means that they could take the new trustee orientation prior to taking their seat on the board. They have to have been elected or appointed, but they don't have to have yet been sworn in.
And I just remembered I've read 45 days somewhere along the line.
Yes, that's actually taken directly from the board trustee training and travel policy. The
And
45 days is specified
And
there.
I asked Doris about it because at CalSTRS, your orientation was prior to your first board meeting. And when you go onto a board, and on day one, you're a fiduciary. And any vote you have is every bit as important as the person who's been there, or counts as much as the person who's been sitting on a board for 20 years. And so my concern was 45 days, people don't necessarily know what their rules are or what their liability is or the importance. I think the suggestion of telling someone to please watch or attend meetings prior to you taking your seat is a good one, but I just think 45 days puts someone at a disadvantage as far as their knowledge.
And there could be instances where someone is elected or appointed and a board meeting occurs within 45 days that they actually could take their seat and make decisions, vote on matters prior to completing the new trustee orientation.
Anyway, that period of time is a concern to me, and I just thought I would.
I will certainly reach out to the successful candidate to see if I can't get this scheduled prior to the first meeting in which they're a voting member.
Thank you.
But we don't want to write that into the policy that you have to attend this. Now, when I first started, I would have been within 45. I came in here earlier than that, but potentially when I was elected, I could have attended the first meeting without having seen this based on this policy.
Correct, and we didn't have the version of the new trustee training that we currently have in place when you were elected and became a member of the board. At that point, it was shorter and certainly much less formal. It was oftentimes just providing you with information on where certain documents were provided and a brief overview. The new trustee training program now is much more comprehensive and in depth, and really will likely be split over 2 days with probably 3 hours per day.
Oh, wow.
I mean, you can
Yeah.
ask Trustee Haschek. We did it all in one day, and I think it was a bit much.
Yes, but we were able to do it long before the first meeting,
Correct.
and so that helped out.
Yeah, I just think in policy, we might want to tighten it up.
Well, is it also a liability of the rest of the board if somebody hasn't been?
That's what
Absolutely.
my concern was, that, I mean,
So if, we could certainly, if we did have one of these rare circumstances, but you can tighten up the language if you want to. I mean, Doris and I could certainly meet with the trustee and have a discussion about the key topics in 1 hour or 2 hours or whatever it is before the meeting. If it was one of those that kind of was falling through the cracks. But if the board wants, you can change the language.
And if so, you can provide direction. I'll bring back the trustee education and travel policy, because that's where the 45 days actually is quoted from, and this with to align with whatever new language the board would like to see. It might be difficult to ensure that they always attend it prior to the first meeting, but as Jeff said, we might be able to do certain stopgap measures until they could obtain the full new trustee orientation if the meeting was very soon to the completion of an election.
does anyone else have an opinion on this particular item, on item 5.2? Item 2,
Did the training,
sub 5?
the training involved you for those 6 hours?
Most of it, and Robert and Judy, and it covered our investments, it covered actuarial work. I mean, it was a lot of information down to just general operational things about our board procedures, and if a trustee wants to travel, who to contact. It was very comprehensive.
So could you videoize it?
We could work on creating, because it's in like 6 different topics or segments, doing some video pieces so they could watch it on demand. Watching on demand certainly doesn't provide the opportunity to have them ask questions and answer specific questions that the trustee may have, but we can certainly work towards that if it's the board's direction.
What if you added on number 5, with the intent of completion of orientation before the first meeting?
I'd be happy to add that language. The policy could be approved with the amendment from the board.
I would, like to see that amendment. I believe it should be handled before the first meeting of a new trustee, because there's just a lot.
So
And I think most trustees, if you're already interested in serving, you're probably not going to be hard to get them in here.
So it also might be a piece of information to give to people when they file to run for a position, or whatever documents are given by the county when they do appointments.
Yes, and this does have information that would be provided to candidates who are seeking election or appointment. The new trustee orientation isn't specifically called out in item 3 of the policy, but it is then subsequent listed on item 5. So we can certainly ensure that someone's interested in submitting a nomination for candidacy, or we get notice that someone has requested appointment by the Board of Supervisors, providing them with this information about the board.
Thanks.
So you made the motion and he amended it. Is there any formal thing that needs to be done for that?
You want to make your motion now with the amendment?
Hold on, I think there might be
Make sure
other,
you made a motion.
make sure there's not other comments on the document. This is the first time this is a new policy, correct?
Correct. And if the board wants to bring it back for a second read for approval, we can do so, but it didn't seem terribly controversial to me. So if it's acceptable, it could be approved today.
I also thank you for adding information technology to the guidelines of what is desired skills. I can't help but think that that was put in there to make me feel better.
I don't believe it was, but I'm glad you're feeling valued.
I didn't make a motion.
Yeah.
That was under the trustee skills and knowledge assessment part?
Yeah, the
or-
guidelines, item number 1, item A under number 1.
You and me couldn't be
Yes.
here.
Approved, yes.
Chair.
Your grandfather.
Oh.
Yes.
Propose a motion.
Yes.
We need to ask for public comment first, I
Well,
believe.
there's no motion on the floor, I don't believe. I didn't
You
make
can
a
get
motion.
public comment before the motion, or do
Oh,
you get
the-
it?
The bullet point says that, but it seems like it would be better after it. I'm sorry, Quincy.
Move the recommended action with the proposed amendment as discussed.
Now you have a motion.
I'll second that.
Okay, we have a motion and we have a second. Judy, roll call, please. Oh, and public comment.
Well, there is no public comment.
Thank you.
Mr. Kelly?
Aye.
Mr. Haschak?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Ms. Covison?
Aye.
Mr. Land?
Aye.
Approved.
Okay, that brings us to item number 6, the administrative report. Doris Rentschler, Executive Director.
Thank you, Chair Land. Just as a reminder, the board performance evaluation is due today. We will extend that deadline to get some more additional feedback. If trustees could please complete the survey by August 29th. It is available as a web link. If you need the link, just contact me. If you would prefer a paper copy, I'll arrange that. But it is fairly easy to utilize it online for those trustees who have. I appreciate it. Also, we currently have one candidate for the safety seat and one candidate for the general seat. Assuming no additional nominations are received by Friday the 22nd, we will ask the Board of Supervisors to order no election and to direct the clerk to cast a unanimous ballot in favor of the nominated members. Pension Gold is our pension software. They have a conference each year. Staff has attended in the past. I just wanted to mention to the board that I will be attending the Pension Gold Teaming Conference in October this year because they had a number of topics that seemed particularly relevant right now. Additionally, it'll give us an opportunity to do an on-site due diligence meeting with them, and I have a questionnaire of due diligence questions already compiled for them. We're also in the process of doing our service provider evaluations for Jeff Burke, Board Counsel, Nossaman LLP, which is the fiduciary counsel. If you are unfamiliar with the work of a specific council member, you don't need, or council, you don't need to complete an evaluation for that. Also, I believe one had gone out for tax counsel. No, I take that back. Since you guys hadn't actually met tax counsel, I had that evaluation simply done by staff and our board counsel. The goal is that we will provide the evaluation results for the September agenda. We will also be looking at evaluating Callan and making some determinations and Barrow and Armstrong, actually, I believe, too, and Siegel. Those will be coming slightly later, so we can make a decision on whether or not to RFP for services for those providers. So if you have any questions on any of that, please contact me. The service provider evaluation is also a web survey with a link that was mailed to you. If you have any questions, need assistance, or prefer a paper copy or something, please contact me. There is one other item that I wanted to bring to your attention, and it is now posted as page 2 to the administrator's report, which is just a change in our hiring processes where we will be implementing a criminal background check for all new hires to the system. I'm trying to work out the registration with the California Department of Justice to be have an agency number assigned so we can request those background checks. And I'm happy to answer any questions you may have regarding that.
Was there a time frame that after so many renewals that it had to go out to RFP?
We don't have a strict guideline on that. Both of the contracts for our actuary and our external financial auditor had come up or expired during the pandemic, and the board simply made an option to renew for another 3-year period. So we've had our auditors and our actuary for a significant number of years. We'd like to do the service provider evaluation to get some feedback from the board on the level of satisfaction with our providers, and then we can make a decision. It might be relevant just to go out to RFP to get some comparable data as far as costs and things of that nature to make sure it's still competitive as far as what we're paying. But that would be at the board's discretion whether they want to RFP or simply ask for an extension of the contract. If there's no questions on anything that I've already covered, my last item is a request for some feedback on the location for the February offsite. We had talked about doing it at the Redwood Valley Behavioral Health Training Center. I also found out recently that the Willits Museum has a conference room and courtyard available. They would provide it to us at no cost since we do have an open public meeting, and I wanted to see if there was any preference between the Willits Museum conference room or the Behavioral Health Training Center in Redwood Valley.
Well, I'll say this about the Wanacott room at the museum. It's a very nice room. It's and it's got big windows, and the courtyard there is very nice. Shaded, oak trees, whole thing, and so it would be a much more conducive environment to spend the whole day.
Might get a tour too.
Yeah,
I'll see if I
probably-
can't arrange
yeah.
admission to the museum as a perk. No.
Yeah.
Thoughts, questions?
I'm just
comments?
looking for direction so I can actually make a reservation at one of those two facilities.
I think in the last meeting I had expressed a
Preference for
preference
the,
for Redwood Valley, but I like this idea. This wasn't on the table, and I'd have no problem going to Willits.
you vote the museum.
It sounds like more fun than the Redwood Valley place that I drive by every single day of my life. Yeah.
I doubt we'll use the courtyard in February.
Our last offsite was in February, and we all sat outside for lunch because it happened to be a warm day. So you never know.
Yeah.
But it might be a little too cool to use the picnic tables and sit outside in the courtyard for lunch, but it does give us an additional option to have that space available. So once I get some direction regarding the location, which I'm hearing now is leaning towards the Wanacott room up in Willits, I would like to just ask right now if there are any topics specifically that you would like to throw out as potential for the February meeting. Robert and I have been discussing several, and you can hop in if you have anything you want to mention on potential topics, but we're really looking for what is of interest to the board.
Will it be a review of the strategic plan?
We could do a review of the strategic plan, although I have an item coming up at the September meeting, which does talk about the strategic plan and maybe some new board work plan items tied to it that are just beyond the initial ones that were established when the plan was drafted back in 2022. So I am going to be doing an update to the strategic plan along with a recommendation or suggestions for certain work plan items that I think should be added at the September meeting. So if the one in September is sufficient, then I would say no, the strategic plan won't be at the offsite.
Any suggestions for topics?
Maybe we ought to ask when it's not.
Well, you're all
People have a little more opportunity to think about it.
You're all welcome to email me any of your suggested items. Okay, that's everything I had, Chair Land.
Okay, that will bring us to, well, first of all, is there any public comment?
There is not.
Alrighty. That brings us to item number 7, general board discussions.
So earlier today, I told staff that I was going to be retiring from the retirement board. And I wasn't sure when, but today's work on the consultants tells me I believe that October will be my last meeting.
I don't think the board will continue to stand.
And we will have a special election. I did check what the requirements were in the serial. So we will end up holding a special election to fill out the remainder of your term.
And what I'll do is, we'll see how September goes, and I'll give an official letter after the September meeting, I think.
Richard, this is hotel retirement board. You can always check out, but you can never leave.
Well, I heard something like that earlier, but it was a little more ominous. It was from the Godfather.
Okay, is there any other board discussion? I do have one quick item I wanted to talk about, just raise awareness. This is where my trustee job intersects with my day job, the IT job, and that is that there are some requirements coming down for ADA on documents that get posted on the internet or on any digital interface that we have with any member of the public. That will probably include documents that we receive from vendors. And so they will need to be vetted through, and any kind of, when they're PDFs, any images that are placed on those PDFs need to have alt tags. There's a variety of things that need to be done. None of them are really hard, but we do need to assume responsibility for that before it hits our website. And Scott, who is the same Scott that you're used to working with, is involved with the project to raise awareness and to come up with the technologies we'll have to maintain that. So I just wanted to throw that out there. Anybody who wants to listen to it, I've been trying to make sure people listen. And so it's an important thing. Those we do on, I believe, April 24th is the final day when we have to be compliant. We don't have to go back and fix old documents, but we might want to begin the process, the practice now of being careful what we post. Our base website has a lot of issues that we're going to be dealing with as well.
I do know that we generally review documents that MSARA created that we post to our website to ensure that they're accessible, but we haven't always checked the items from our outside consultants and things of that nature.
We will need to do that. We will also need to do that with LRS.
Yes, and LRS is already aware of that. We have spoken with them, and they are looking at the documents that are posted or available on our member self-serve portal.
Right. Are there any other general items for discussion?
Recently, in the past week or so, I encountered a story coverage of how Oregon's deciding to more heavily weight its private equity is now coming to bite them in the tail, because of course private equity is no CD or guaranteed type of return, and their systems that are participating in that are now having to really pony up. There's like $100 million, I think, deficit for Oregon.
Oh, geez.
That's all.
So private equity is a very popular investment vehicle that I've seen, at Sackers and talking to other people. We're not involved with that, though.
We don't have any private equity or private credit at this point. For alternatives, we really just have the infrastructure and the real estate options. Private equity has been very attractive, but it is an equity product and it comes with risk. It's not immune from that.
LLCs are not. private equity?
There are some private equity pieces that you may own as part of a limited partnership. I'm not that versed in what Oregon was invested in, so it could take a variety of formats.
I know that LLC, by some of these we were working with today, listed that as a form.
Oh, as far as the managers that we were looking at for the core and the core plus, that's the structure of their organization, but not that they would be doing like a private equity type thing, although this is private real estate for the core and the core plus, meaning that that they take actual ownership of the physical property.
But then we become a limited partner in their LLC.
Is that?
Well, so
take it with you
when you hear private equity, you need to think small cap, micro cap companies. You need to think high leverage, right? So my analogy, which is not perfect, is when you hear people talking about private equity, that is the worst companies in the Russell 2000, right? Worst being highest leverage, smallest companies, tightly controlled, right? We already have a structural tilt to small caps,
As far as the core and the core plus and some of those firms being structured as an LLC, we wouldn't be coming in as a partner to the LLC because they're running a fund, I believe. But there are some types of investments where you do become a limited partner. I don't believe that would necessarily be the case in the specific ones brought forth, but we can double check that.
Well, we would be limited partners in all of these funds we're going to be reviewing.
Oh, all right.
Absolutely. We will absolutely be limited partners in those funds. 100%. Yeah. Yeah.
Okay.
Okay, any other board discussion, general board discussion? Any items anybody else would like to discuss?
No.
No.
Seeing none, is there any public comment?
Depends.
There is no public comment.
Okay, that brings us to item 8, adjournment and notice of next Board of Retirement meeting. The next Board of Retirement meeting will be held in the Mendocino County Employees Retirement Association Boardroom, 625B, Kings Court, Ukiah, California, on Wednesday, September 17th, 2025 at 8:30 a.m. This meeting is adjourned at 12 noon. Straight up.
Good.